Recording. All right. Hey, everybody. Thank you so much for joining us on the second day. I have not much else to say, so I'm going to turn it right over to Tyler. Hey,
Oh, terrific. Well, Leah did a great job last night getting everybody videos of yesterday. I hope none of you wasted any more of your time and watched it again last night. I did watch various parts of it just to make sure I understood what was said and what wasn't said going into today. This is going to be a great day, really fun. For those of you joining us from the Las Vegas workshop, I kind of cheated yesterday and I introduced a number of charts that we did not look at in Vegas. We are going to look at them in detail today, but just as a frame of reference, you might want to go back to part one, yesterday's, to take a look at them. I think there was about 14 different hyperwaves currently in various phases. We didn't go into the analysis of the how to invest in them or what tools to use. We're going to do that today in great detail. So today will be very similar to yesterday. We'll go for about an hour and a half, take a short break, another hour and a half, take a short break, and then another hour plus an hour or more afterwards. We went almost 5 hours, maybe a little more, not including the breaks yesterday, taking some questions. An awful lot of other questions came in. So we'll keep it open. We'll stay as long as necessary to cover them. But today is all about, well, let me start by saying I hope that a lot of you have come to the conclusion that these things called hyperwaves are real things. It's not just cherry picking a number of bubbles over the years and finding similarities and calling them something. They really are entities quite different than any other. And we spent a lot of time talking how and why yesterday. We'll do a little of that this morning just to catch people up on the perspective, but not very much time. Hopefully in vlogs and other places you've gotten to the point you understand the basics of hyperwaves, and you can locate them and tell the difference between those and other bubbles that are sort of behavioral driven. Today's all about, okay, stipulating or assuming that these things are real, number one. Number two, they don't occur very often, therefore they're not particularly useful a lot of times until you find one or two or three that fit all of the descriptions. But then once you've done that, they become very, very valuable from the point of view of trading or investing. They're long-term, so I consider them as investment tools as opposed to position trading tools or short-term timing tools. There are a lot better ways of doing that than this big, burdensome, bulking, hulking thing called a hyperwave that plays out over many years. We went a little bit yesterday into the fact that I still believe but cannot prove that hyperwaves tend to occur when there's big shifts on the world economic scene taking place. And we're going to spend the first hour and a half today looking at 3 hyperwaves that I participated in using what I knew about hyperwaves at the time of each of them. The first one's going to be the Japanese Nikkei going up to their peak in 1989. And we're going to look at it from the perspective of how I made investment decisions going up during the 1980s and how, because I knew what hyperwaves were, I started looking for a top. And I'll show you the various tools that I use to determine that top. We've already discussed one, which is the obvious one, which is breaking down on a weekly basis below a phase 4. But there are other tools that you want to use. And then we're going to take a look at the dot-com bubble by looking at the NDX, the NASDAQ 100, the 100 biggest stocks in the NASDAQ over the years where it built up to its peak in March of 2000. I also was involved in that. I was managing a lot of money for institutions. I saw it coming, and we were able to step aside. But I want to show you how, what investment tools and techniques, technical tools I used. I knew more in 2000 about hyperwaves than I did back in 1989, where Japan peaked, because I hadn't yet realized or discovered in 1989 what a funky hyperwave was. I did early in the 1990s, which allowed me to do a number of things from 2000 on using that knowledge. And then thirdly, we're going to take a look at Bitcoin, because I was able to ride the upside. I was able to get out at the top, and more importantly, able to stay out ever since. I'm going to do them in that order. So we're going to look at 1989 first. I'm not going to go into a lot of the fundamentals behind why they took place. It would just take far too long. Only to say that each represents a very obvious shift in the world economic scene in terms of Japan taking its place as the number 2 economy in the world after being decimated all the way back in World War II. And for 20 years, then it built into this hyperwave. Then in 2000, it wasn't just the dot-coms. It's that technology had taken hold in the late 80s, early 90s, and built throughout the 90s as computers became faster and faster, and memory became stronger and stronger, and transaction costs in terms of the cost of chips began to fall sharply. That changed the world because of the internet and because of everything that we're doing, including this webinar today. None of this was possible except for that period that led up to a hyperwave that peaked in 2000. And then finally, we're going to look at Bitcoin, and I don't need to explain why I think it's so important from a macroeconomic point of view, and why a shift has to take place and is taking place, and that was brought to us back almost 10 years ago. So we will get started with that, and we will do it by going to screen share, and we will do that by doing this, and then this. And the first thing I'm going to bring up, just so everyone remembers, is this. That's it. That's the hyperwave. That's simple. It looks like a child's drawing, and basically it is. It's that simple. Obviously, a lot of complexity to it, having to do with why, how has it gone for 100 years unchanged? How has it not been noticed by other people? And how is it so difficult to explain to people why it's real and why it's useful? But many other questions about it having to do with the shape and these vertexes. We spent a lot of time talking about the vertexes because they're very important in distinguishing hyperwaves from bubbles and distinguishing hyperwaves from parabolic moves, even though a hyperwave has the characteristics of a parabolic move if you draw a perfectly fitted curve at each of the vertices, some of which are much wider than others, and so you get a lot of spacing in between. The big things to be looking for as I talk about Japan and the NASDAQ 100 and Bitcoin are each of these pieces. But mainly what we're doing from a trading point of view today is saying, okay, when is a good time to start getting into this? We know when is a good time to get out, obviously the peak at 4. How do you do that? What tools are available that I used in all 3 of the cases we're going to look at, but that everybody can use for every hyperwave because the rules are so consistent? So keep this in mind as we go through. And now what I will do is I will bring up something else. And let's see if that works that easily. Maybe it does. Wouldn't that be cool? Let me bring this one up. Can you see that okay?
Not yet, just the archetype.
Okay, that means I've got to stop sharing. And then I've got to start sharing again, which seems a little redundant, but who am I to say? How about that?
Boom.
Boom bada. Okay, what we are looking at is the Japanese Nikkei 225 on the monthly basis going into a peak above 38,000 back in 1989. And I've cleaned up the chart so we're not looking at all kinds of other things. I'm going to change it to the weekly because that is always what I use in analyzing hyperwaves. Weekly closes are the magic elixir. I've tried monthly, I've tried daily, I've tried short time frames. Weekly works well. Now, maybe that's because I always use weekly candles. I have since the 1970s. I used to use open, high, low, close. I like candles better. It's more precise when you use open, high, low, close bars. Precise when you're drawing phase lines. Because you can put the pencil line, which should be shaved down to a very sharp point, right at the closing price intersection with the bar. Whereas on candlesticks, you've got all that fatty tissue all around the thing. It's a big, ugly thing. It's great in terms of the height and the width, the wicks that appear and stuff like that. But in any case, I'm going to use candles because everybody uses them. I was not using candles back here in 1985 through 1989. We're looking at the last 4 years, which is a move from 10,000 up to 38,000. So 4x. But this really started back many, many years earlier, and with a very long build-up period. We're just going to look at the top. And the reason is, as we go up into 2, 3, and 4 over this 4-year period, from 1984 to 1989, 5-year period, I want to look at a bunch of things and a bunch of tools. The first one I'm going to look at is Consensio. Let's just assume you didn't know anything about hyperwaves, but you knew about Consensio. I'm using 3, 7, and 30 week moving average, a 3, 7, and 30 week moving average. Now, I've explained in other places, other webinars on Consensio, the reason I use this stupidly short 3 is because it tends to run right through the middle of all pricing when you're using weekly prices. And that's obvious from the point of view that it's only taken in 3 candles. Therefore, even on very big moves, such as this huge drop here, that weekly or the short-term moving average tends to stay right with it all the way through. No matter how big the upswings, how big the downswings, you've got this thing running through the middle of price. It's a 3-week moving average. Now, you're going to have to go back to the Consensio webinar to understand why and how, but just for today, we're going to use that going through not only the 3 charts that we're looking at in this first hour and a half, but all the other charts of current hyperwaves. These 3 hyperwaves have come and gone, including Bitcoin. In my mind, it's come and gone. Uninteresting, except to look at and explore what you did, what I did, how we did it, why we did it. That's what's great about going back and being able to go through a historical chart. If you went back and looked at a historical chart that you actually participated in, and almost all of you participated in that Bitcoin hyperwave, almost none of you got out when you should have. And some still today say, I would never get out no matter what, which is fine. That's a religious thing that has nothing to do with investing, though. Okay, so 3, 7, and 30. Now, my definition of a bull market, forgetting that this is a hyperwave for a second, and we don't know anything about these phase lines, 2, 3, and 4, what's going to come, a 5, a 6, and a 7. If you didn't know any of that, but you only used Consensio just as one tool, and I like this tool very much for complementing what you are doing with a hyperwave. It gives you additional evidence that does not show up with the simplicity of hyperwave. So it's an overlay. Okay, so we're going to pretend we did not know this was coming. We didn't know this was a top. We weren't looking for a top, just the opposite. We think, and the world thinks, that this is going to go forever, that the Japanese economy is taking over the world. And that is not an exaggeration. Go back and read the history, the 5 years from 1985 to 1989. And then look at the economics of what was going on. And I've already told you the 10 biggest banks in the world at this point were all Japanese. And I've given you information about real estate and all that. I'm going to try to keep away from all the anecdotes. They're interesting, but we've got a huge amount of information to cover. So back to Consensio. Here's the long term, which is a 30-week moving average. And the price just stays above it forever. Therefore, it's not a timing tool. It will become a timing tool over here, but that's too late for me. So I've got these 2 short ones here. And now what I'm going to do is I'm going to take off the price. And those of you that haven't listened to our Consensio webinar, the reason I take off the price, which everybody, there's no question it's the most important thing. That's what you put your fiat money into, and that's what goes back into fiat money when you sell. It all has to do with price. But analysis is different. I said yesterday that the weird thing about hyperwaves, the hyperwave structure has nothing to do with price. Price can go way, way above hyperwave phase lines, They are not like moving averages. They are predetermined without price ever entering them. It's only that when price falls into this trap, it's like a have a heart trap that catches animals live. Once an animal goes into that, it is trapped inside the structure. That's what a hyperwave is. A hyperwave traps price within it, and all the fundamentals and all the technicals in the world and all the opinions and supply and demand have no effect on what the price must do, going all the way up to a peak and coming all the way back down again. Okay, so we've got these two other moving averages without knowing what the price is, and it doesn't matter that we're looking at the Nikkei 25, and it does not matter that this is a hyperwave. What this would tell you is from 1984 all the way up until July of 1990, you would want to be in this thing, whatever it is. There were only a couple of occasions, very short and very small, here, 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 and finally at the apex, in which you would have questioned your 100% position. Now, this is not 100% of your assets. This is 100% of X, where X is the amount devoted to this particular investment. Please go back to our webinar on money management to understand what that means. From my perspective, 60% of someone's investable assets should be in very broad indexes. 25% should be in sectors and industries, and 15% should be in individual securities or speculative things such as Bitcoin or mining shares or very volatile things you can make a lot of money in short periods of time. That's very different than the rest of the investing world looks at in what we're talking about, which is taking wealth, fiat money, and converting it into something that's riskier than fiat money. In any case, we have webinars available to anybody that would like to get into the philosophy of that in depth. But in any case, over a very long period of time, you just had to be long the Nikkei 225. Now, I've got some rules in Consensio. We're not going to go into all the rules, but basically it says that you want to lighten up on the thing that you are in when the price drops below the short and the intermediate term moving average, and the short-term moving average crosses below the intermediate term. It did very briefly for a couple of weeks here. Now, I've got rules about that too, rules about everything. But they are my interpretation of what I have observed as being the optimal way of reducing risk while not totally getting out of something, therefore reducing reward. And with Consensio, I do it with several steps: 5, 5, 5, 10, 25, and 50. If you add those up, that's 100%. And I take these little steps because you never know when using moving averages, when this stuff begins, how far it's going to go. Let me just, with this example, quickly go over that. Here, for a brief period of time, we have price go below the short and the intermediate term, and we had the short cut through the intermediate term for a very short period of time. That to me is a 5% move out of X. So if I'm 100% in, let's just use $100,000. I've got $100,000 in this thing. I take out $5,000 and I put it in cash. I put that 5% right back in, the $5,000 right on this candle. Why? price is above the short term is moving up, the short term is above the intermediate term, you're back in a bull market. Well, didn't you just waste some commission? Of course. So what? Big perspective. Keep a big perspective. Don't worry about nickels and dimes. The big perspective is risk versus reward. Getting out before things get bad. Getting in after things get good. Okay, let's take a look at the second example I would have done something. Price cuts through the short-term moving average. The short-term moving average moves down, and right there, the short-term moving average moves below the intermediate-term moving average. So price is now below the short and the intermediate, and price and the short term has cut through the intermediate term. And right here, the intermediate term is turned down. So I'm 100% X going here. I now do a 5, and maybe another 5 off of this candle because it's so far below the declining short and the intermediate is turned down that I'm worried that this candle isn't going to take place. So I might be 15% out. I might be 10. I might be 15. I'm still in this thing anywhere from 85% of not or 90% of X. Here on this candle, price cuts back up, which quickly turns the intermediate back up. I'm going to take the price off once again because our tendency is to fixate on price. And these lines have 100% of price already in them, but spaced out over various time periods. That's what's so marvelous about this simple thing called a moving average. In any case, here the short term turns up, but the intermediate is still going down, but here the short term accelerates up, and it also cuts through the intermediate term in the next week, which turns the intermediate up. So now all we need to be fully back into this is for price to be above all of them. So we got to put the price back on, and there it is. And right here on this candle, price is above both of them. And on this candle, price is above both of them, and all three are still moving up. Now, notice I haven't said anything about this line. We don't know that this line is going to keep going up forever. But it is not part of my decision making until we get over here. So we're back fully 100% in. We might have gotten out at we definitely got out on a profit on this run. We got back in during this candle, so it all depends on when you got out and how much you took out to determine what was your thing called slippage, which assumes you never get out of anything, which is the way the world looks at investing. You buy and hold forever, good stuff, and it works out in the end.
Tyler?
Yes, please.
Maybe a quick question just based on live chat.
Of course.
Why for this are you using monthly rather than weekly?
Only because of the time span, but you're correct. Let's go back to weekly. And let's go back to all. And let's go back to weekly. Oh, see what they did? Oh, I didn't realize that. All it means is I've got to scroll all the way back when I go to weekly, which is fine. Okay, bingo. Good call. Sorry. Say everything's exactly the same as what I just said, but now we're going to look at the weekly chart. I'm going to roll this up bigger and bigger. So we're looking at the same three points at which things are happening, but you're correct. Consensio is always used on a weekly basis, not a monthly basis, and therefore what we were looking at is not as extreme as what really happened year over year, because weekly moves a lot faster. But let's quickly just review these three things again, the 3 points. Here you get about 1, 2, 3, 4, 5, 6, 7, 8 weeks down, which is 2 months. And when you take the price off, you see that, first of all, um, there are some periods where you get a flattening out of this 30 week. I thought we were looking at the 30 week, but it never goes down until up here. Then it goes down briefly, but that's great. Good catch. Let's do the same thing very, very quickly. Maybe when you go through a sideways period like this, particularly where things are all flat, you're going to get the short and the intermediate term crossing over back and forth, back and forth, back and forth. As long as the long term is moving up during that and you don't really penetrate the long term at any time, there are different ways you can play that. By making it much bigger, you can actually see where little crosses are taking place. Support on the long-term moving average, which in this case is 30 week, not 30 month, and where you would make your decisions based on where the price is. I'm going to quickly put the price back up just so you can see where this is all taking place. When price is coming down and then bounces back up, the short gets right above the intermediate very quickly. It all comes apart again, reestablishes over and over again. And so you can have a lot more trades when you're looking at that weekly. I always start with the monthly on everything, including hyperwaves, including Copic curves, including Consensio, but I only use Consensio to make decisions on a weekly closing basis. Now, during these kind of periods where all three moving averages are very closely together, slippage becomes a very much more important thing to consider. And what I mean by that is you can get whipsawed back and forth and back and forth. And we will look at this when we take a look at the NASDAQ and look at even Bitcoin. This flattening period where the long-term moving average is moving up, you expect support. And when you get a break like on this week, it immediately responds back with a positive move back above it, because that long-term moving average is so important relative to a 3 or a 7. Sometimes I use a 15, which is sort of halfway in between. But on Consensio, 3, 7, and 30 is what I use. And if you convert that to daily, we're talking about 15-day, you're talking about 49-day, and you're talking about 180-day, which is close to a 200-day moving average, close to a 50-day moving average, and close to a 14-day moving average. That's why I use these. But anyway, where you find all three moving averages moving parallel together, you can either stay in and not let yourself get whipsawed 5, 5, and 5, or you can take a big chunk out, 25% out, and just sit out and wait for them to spread apart, either above or below the long-term moving average. Again, this isn't about Consensio, but I just wanted to make clear that when we moved from the monthly to the weekly, you're going to get a lot more trades. Okay, let's go to the actual corrections that take place along the way here. Here's a first flattening out, but look how far above the moving average you are, this moving average. So you're not worried about this falling apart. So you could you could watch for price to break below the short term and turn the short term down. It does not do it. Price gets below the short term, but it does not turn it down until this candle looks like it flattens it out a little. This puts it right back into a bull market. Bull market definition: price above short term above intermediate, intermediate above long, and all four moving up. That's a bull market. If any of those get disturbed, you start questioning the bull market. Here's the first question you get right here. Why? Because price breaks below both the short and the intermediate on one bar. It does not respond on the second bar, and the short term turns down, and the short term makes it all the way back to the intermediate term. We do get a stoppage of the drop, but you don't know what's going to come next. Would I have taken 5% out with this drop? Yeah, I probably would. I've been in this thing for a long time. I've made a lot of money. I don't know where the top is on this. We haven't had the big move yet up. I might have taken 5% out on this drop because it was so severe, cut through both moving averages, closed below both moving averages, turned the short term down. I might have taken 5% out. Here, I'm not sure what I would have done. Maybe another 5% because it's below both of these. And if it stays down here, the short term is going to cut through the intermediate term. Turns out that didn't happen. The very next week, everything was fine again. I would put the 5% back in. I would take the 5% back out because we break on this through both the short and the intermediate term, followed by another one both below the short and the intermediate term. The short has cut through the intermediate term, and the intermediate term cuts down at this point. I would be 15% out of this in some measure on these three bars. Now it really gets tricky because now the short term is really hurtling down, and the intermediate term is hurtling down. The short term is beneath the intermediate term, and it just keeps on going. And price breaks the long-term moving average here, here, and here, while the short term cuts through the long term, and here, where the intermediate term cuts through the long term. I'm 50% out of X. The long term has not turned down, and that is my signal to exit the position. I might exit because of the profits that we've already got if these don't happen. If we stay below this long-term moving average, we don't have to go way down, but if we stay below it so that I know that the juice is being taken out of the long term, and it's going to be hard to turn the short and the intermediate term up, I might take additional action above the 50x that I've already taken. But just the opposite happens. We stop going down. We have a very nice close. Here we've got a hammer the tone would love. Let's just take a quick look. Got down to a 7. Okay. But anyway, the price dictates to me what I'm doing with Consensio. This breaks above the short term, which means that will eventually turn the short term up. It has not done it yet. I have not taken any action. I'm still 50% of X. Here we have another higher close, and we're above the short-term moving average, which tells me now the short term is going to start moving up more rapidly. I still haven't taken any action, but I'm getting curious. Here, we break above both the short and the intermediate term. The short cuts through the intermediate, and price gets back above the long-term moving average. I probably put 25% back in. I'm now 75% long and 25% in cash. Here we are a full body of the candle above the long term, the short term, and the intermediate term. The intermediate term has turned up. I put the final 25% to work on this candle. We're above the short, the intermediate, and the long term. The short is above. I might have misspoken there. I probably would not put that 25% in until this takes place, which is the intermediate term cutting back above the long term. Now, during the week, you can make your decision by looking at daily charts. We know that the intermediate term is moving up. We know that the price is well above both the short and the intermediate term, so the intermediate is going to accelerate. And we're getting very close to the long term. Would I front run it? Probably not. I would probably wait for this cross to take place, and now I'm 100% in, and you're back in a bull market. And the reason I'm pausing here is this is a big drop, and I haven't seen these for a long time in this particular thing, and look how long it lasted. 1, 2, 3, 4, 2.5 months. So that hurts. And so you're not sure. You have not retaken the tops again. So I was premature saying I would have put that to work that early. I would wait for it to reach back above its highs and for this to cross over. On one of these in here, I would have done it. Okay, so I'm 100% back in. Consensus is back in a full bull market, and now it starts going crazy again. So now we're moving from 18,000 to 25,000 in a fairly short period of time. And we think this thing's going to go forever. Okay, it doesn't go forever because market's correct. Instead of worrying, should I get completely out, or where's this thing going to go, or should I stay completely in, just use these simple rules. Price starts breaking down. Short term goes below the intermediate term. Intermediate term moves down. But look how high above the long-term moving average. We're not worried about this thing ending, but we know that a correction is taking place. So you get a 5, you get another 5. When the short goes through the intermediate and price is below all of them, you get pretty excited on this wick, believe me, because it comes all the way down during the week to the long-term moving average. So you don't know this is about to happen. So on Monday, Tuesday, Wednesday, Thursday, you're going, oh, good grief. You know, here we go again into one of these big things. We're going to cut through the long term and all that kind of stuff. Well, we don't. And that's why weekly closes are so important, not only with hyperwave, but with Consensio and everything else I do. It's just, you've got to give it time to do its thing. It's hard to do sometimes. You don't have to. If you want to front run the signals, you can. But anyway, I'm going 5%. I'm going another 5% when the intermediate turns down. They don't make it. Price doesn't make it down. So probably 15% is all I do here. I'm pretty confident. I've got big profits on the table. I really get bullish on this close. I say, oh my gosh, here we go back up, and sure enough, we do. But I wait for the evidence, and the evidence is where the price gets back above the short term. Then you've got this cutting through both of them, closing at its highs. It continues. You're back 100% in, not knowing what you see on the chart. But you're 100% in because price is above short term is above intermediate term, above long. That's the definition of a bull market. This is one of the problems I had with the gold market last year. Because of it kept throwing in these little things that got you in and out. Instead of jumping in and jumping out, you do 5%, 5%, 5%. When it reestablishes it, you're now 90%, 95% back in 100. Then you go again, 5%, 5%, 5%. This killer came along, dropped through everything in one candle. Price, short term, intermediate term, and long term, and closed down here. That's a 5, a 5, a 5, a 15, excuse me, a 10, because within the week, when you break it down day by day, depending on what days this goes, you're going to find the intermediate term cutting through the short term cutting through the intermediate term. Right here, the intermediate turns down. But it doesn't turn down in between these two candles. It's because of this candle. So on this candle somewhere, you should be 25% out, thinking you're going to do another 25%, because these things go rip-roaring down in these next two candles below this, and you're 50% out because of that action, but not on this candle. 25 on this candle, and another 25 on this candle, because you are basically in a full bearish posture. You're looking for the last 50%, and the long term does turn down because of all this action. You are completely out of this weekly trade. And you did it at 22,500, most of it after being up as high as 26,000. Sometimes there's nothing you can do about it. The size of this bar is 26,000 on the top and 21,000 on the bottom and 23,000 on a close. That is an enormous candle. Okay, you're out and you're tired of playing this silly game, but it doesn't go any further. You've got some wicks that drop down to 21,000, not that far from the lows here. Here, it tests the lows from 6 weeks earlier, but then you get this great bottom doji, and it immediately things begin to happen. Price gets above short and intermediate term, gets above both of them. They both turn up even before you get back up here, but you're never more than 50% in until this thing turns back up. And that doesn't happen for a while. So we're only talking about 50% basically. But you do get that 50% in at this point. Price is above both moving averages, which are moving up. You are still scared to death. You have no idea what happened here. Somebody should go back and take a look. The date there is the 19th of October, 1987. What a surprise. That's the day and the week that the stock market in the U.S. dropped 22% in one day. Sorry, I wasn't thinking about that. That's what happened there. You get back in fairly quickly. You're not sure what's going on in the world. We're keeping politics and finance, everything out. We're just looking at one chart, and we're looking at Consensio. Okay, you're fully back in. The moving average has moved up here. One of these candles, you should be 100% back into this trade. Okay, bapa. Couple of sideways things. Everything I said about the sideways movement, where all the moving averages come together, same thing as the one we saw before. It's up to you how you want to play that. I don't like jumping in and out when short-term price and intermediate term are all going horizontal. How early can you tell it's going horizontal? Not very early. You know, you have to act on this because you don't know that this is coming. So you act on it and you take a 5 out, maybe another 5, you're back in, back out, and you say, look how close all these are coming. And by the way, they're all coming over to an ascending long-term moving average. I'm just going to hold what I've got and let's see what happens. And what happens is after a slight penetration of the long term, you're back above it, and now you're running again fully bullish. All three going up, price above it, on and on and on. A little correction, maybe a 5 and a 5, more sideways action. But look what's happening to price. Price keeps going higher lows and higher highs all through this period. You've got to notice these things. If you knew hyperwave, what you are looking at is a 2, 3, and a 4, but you don't know hyperwave. We stipulated that you're just using this technique. So let's look at the top using just this one technique. I'm taking way too long. I'm not going to take this long, but I want you to see how you overlay other tools on top of hyperwave. Okay, we run all the way up to 38,800. And most of the time you're fully in with some 15s out, some periods of time where you're flat, but long term just keeps going and going and going and going. Now, what a lot of people do is they wait until the long term turns down, which is here at 35, 36,000, which isn't bad off of a 38,000 top. It could be you could have just used a long term moving average. Let's see what Consensio would have done real time. Price stops going up, cuts through the short-term moving average. Here, the short-term moving average is moving down, and this bar cuts through both of them. So I'm a 5 and probably another 5. Try not to think of the fact that you've ridden this thing up, you know, at least 400% if you started late at 10,000, and maybe as much as 10 times that if you knew hyperwave and got in on what was a 1 going to a 2, which you wouldn't do, but you might, if you were thinking hyperwave-ish, be saying, here's a breakout above a 1. But in any case, you've got huge gains on this trade. And so without knowing hyperwave and not knowing that this thing is going to break a 4, what you do with Consensio, as this comes down, you're at least a 5, 5, and a 5. Here the intermediate terms cuts down, and here the price drops below all three, and the intermediate has already turned down and is accelerating, and the short is accelerating quickly. That happens here. The intermediate has turned down already up here. Short is coming down. Even this little bounce doesn't turn the intermediate back up. And right here on this, you've got the short and the intermediate. Early in this week, this occurs on a Monday, October the 19th. And continues until the end of the week. Let's just take a quick look at no, I'm not going to change that. Anyway, you want to be at least 50% out at the end of this week. You want to be 100% out when this long term turns down. How you do it between these three candles is up to you. And everybody's got to make their own decisions. So you're out of the trade just as you were out of the trade back here. Remember, you were out of this trade. Or was it back here? No, it was right here because the long term turned down. Okay. So you're out of this trade. Now, you don't know where it's going. Hyperwave does. Hyperwave tells you at this point you are going down below 10,000, probably down below 6,000. We ended up many years later, 20 years later, getting below 10,000, getting below 7,000. One of the longest phase sevens. I called this top in the press on this candle. And I said, we are going all the way back down below 10,000 in the Rocky Mountain News, the largest newspaper in Denver, on at the end of this week. It just so happened that the editor, business editor of that paper was my my wife's husband, whatever you call that. Nope, that would be wrong because that would be me. My sister's husband. What is that called?
Brother-in-law.
Yeah, obviously.
That thing.
Any idiot knows that. Okay, so I said, I'm calling for the Nikkei to drop below 10,000. And of course, newspapers love stuff like that. So he wrote an article and said this idiot thinks it's going below 10,000. Okay, but that was from hyperwave. Consensio doesn't tell you that. What would Consensio do? Get you out completely on this close when this turns down? When do you get back in using Consensio? Well, down here, if you got in here, which you could have done with some fives, but with an accelerating long-term trend line, you know, you got to make up your own minds. But I wouldn't be getting into this because of hyperwave. I would probably have played this if I didn't know hyperwave. And it worked out pretty well for a short period of time, 24,000 up to 26,000. But then when can you get out with any profit? You might be able to do it. At some point, you've got to realize that this is a for real bear market. And clearly you do that as you get into the 4 or 5 years later, 1993, 94, 95, it bottoms out. You can play these using other tools, not knowing that this is going to then occur in 2001, 2, and 3, and you're dropping all the way down to 7,000, and not knowing that after this big run up, you're going to drop down even lower at a later time. And this thing, you know, just kept going on till 2013, basically, where we started a new move up. Okay, way too much time, but I think very important. I only looked at one thing, Consensio overlaid on top of a hyperwave. When would you have gotten out on the hyperwave? You would get out on a weekly close below the phase 4. I would draw that phase 4 from this point through this point up through here, which just happens to be this close takes that out. You're going to find the same thing when we look at the Nikkei, the NDX and Bitcoin. But we, rather than take my word for it, we're going to look at it. Now, I'm not going to overlay a lot of other things on this, but I would just like to do a couple of quick things on this chart. That if you didn't know hyperwave, there are many, many other ways, including RSI and other things to make that decision. But let me just throw up a quick stop and reverse point. Nope. Yep. Oh, I already have that. I don't want that. I don't like other people's strategy. Okay. Stop and reverse point. Oh. Okay. Weekly stop and reverse points. I'm going to take these moving averages off for now. So you can just look at weekly stop and reverse points. You will find that the little signals that we were getting on Consensio, the 555s and all of that, the same thing happens here. So the question is, this is clear, right? up, 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 out. So that's one way of recognizing a phase 4 where the persistence, also a phase 7, the persistence of stop and reverse points by the distance between them and the price is untouched for a long period of time. And the spacing between them begins to grow. I knew stop and reverse points at this point in history because I had learned it 15 years earlier from Wells Wilder, and I loved it from the beginning. I still do. Now, that would also be a reason to look at some of these bounces, including these off of the 21,000 bottom, because this candle started this long uptrend, which lasted many, many, many months. But that's not hyperwave stuff. That's just another technique that if you overlaid that onto hyperwave, guess what would have happened? It actually would have gotten you out earlier. And that's because the way this is calculated, it's not a line. It accelerates up over time. And therefore, a stop and reverse is a wonderful way to get out of a hyperwave even before a phase 4 is broken. Now, that's all I'm going to say for now, because we'll look at some other things in just a bit. What I am going to do is I'm going to pull up another chart. And the one I'm going to pull up, I've got to move this little guy here for now. The one I'm going to pull up is the NDX. And I'm going to put this guy back over here. We're still on a weekly. I don't want stop and reverse points now. I do want my moving averages back up, so we can do Consensio. And now we want to go back to the run up to 2000, which I know you can type in somewhere, but I tried it all morning and it irritated me, so I'm not going to do it. Okay. You've seen this chart because we've shown it on a number of our vlogs. And this was an unbelievable period of time for a lot of reasons, but let's just go back as this thing is moving up in its phase 2, phase 3, and final phase 4 of a hyperwave. The phase 4 goes from 2400 to 4800. 2400 to 4800. We actually went over 5,000 on something or other, but okay. So the phase 4 in itself gave you a doubling. And the reason for that was in 1999, the NASDAQ was up over 80%. I think it was 84%. It might have been 88%. It was stupid for a huge index to do what this thing did. But what it did do is it gave you a vector, a vertices, a vertex, not a vector. It's actually a vector too, away from these other vectors, which came very clearly at the end of these periods of time. Okay. So as you're working up from 1,000, 900, 800, having no idea that this monumental tech move that developed into more than that, which was a dot-com bubble, it is very wrong to look at this period as a dot-com bubble. A dot-com bubble occurred, but that was a tiny, tiny part there were many, many, like cryptocurrencies, against a substantive center, which with cryptos is Bitcoin. With what you're looking at now is real technical innovation that brought us the internet, but brought us so much more. IBM and Microsoft and Intel and Cisco and all of those things were powering through this thing. Huge innovation. The world was changing. That's why I consider this a world macroeconomic shift taking place. But if you didn't know hyperwave and you just knew Consensio, and then we'll look at stop and reverse, go through the same things that we just went through. But keep your eye on the long-term moving average. Let's make sure we're doing this right this time. Weekly, 37 and 3. Okay. And this is the NASDAQ 100. We're only talking about 100 stocks here. We could look at the NASDAQ. But because these are the biggest stocks, it's filtering out a lot of the dot-coms. So that's why I told you, don't be looking at this as a dot-com bubble. That's peripheral. It was coincident, but it was peripheral, because a lot of people wanted to make a lot of quick money doing a lot of stupid things, and a lot of investors that didn't know better got caught up in it. I hope that sounds familiar. Okay. We won't go back forever, but let's go back at least a couple of years as this thing's getting going. We're starting at $600 down here. We know we're going to 4,800. So we know we're about to go 8x in 2 years. But let's see what Consensio would do. Sloppy, in and out, but the long term's moving up. So because the long term's moving up, we're not thinking in terms of this coming to an end. There is some flattening out on a couple of periods here. This is still going up, up all the way to the end. Okay. So just like Japan, very similar structure where you move well above and Consensio catches it, but then you get corrections and you've got to make some decisions. And then way above and accelerating long-term moving average, you don't have to make so many decisions. In this run, here you do. Just as with the Japanese stock market, you've got questions here. You're 50% out. You're not thinking the other 50%. Why? Because the long term just keeps on trucking up. And it's trucking up because you get so far above it at various times. But there are 5, 5, 5, 10s, and even 25s as you break down through this long-term moving average, but then boom, right back up again, fully in a bull market. You didn't have to worry about the long term, but you did have to worry about these shorter term moving averages. Let's just take a real quick look at them. Shorter term moving averages did cut through the long terms. You need to be 50% out with all this pricing for 5 weeks in a row below the long term, even though it still moves up. You hear Peter Brandt and other brilliant, experienced investors tell you that this is the thing you look at, this long-term moving average. This is what investors look at. Speculators look at this short-term stuff, and semi-investors, semi-position guys look at the short and the intermediate term, but long-term investors, this is the Bible. If it's going up, even though price drops down through it, and even though other moving averages cut below it, you hold your ground. And most often you're rewarded with this kind of action. Sometimes you aren't. Sometimes big things are going on and you break down and that turns the long term down. And that's why the rules are the rules about how you step in and out of trades. And why I've got my own set of rules, 5, 5, 5, 10, 25, and 50 to totally reverse from a bull market to a bear market. But it takes steps and it takes other technical things to think about, but I'm just showing you the highlights here. Okay, now we get the big run, boom. Now we run into problems again, just as we did down here. These are bigger problems because we spend more time below. And we're giving back a big chunk of the run we had here. This is a nasty, nasty thing. When is this? This is December 97. This could very well be long-term capital. I can't remember. It doesn't matter. It's something. It's some news item and something that people think is fundamental. But anyway, it was enough that now the long term does not turn down. It flattens. We'd have to look at the exact things, but to me, it's flattening. But I'm very nervous down here. I'm out of at least 50 off of this drop because it all happens quickly. Luckily, I don't do it all at once because of this. Consensio says, boom, price below both, short below intermediate, intermediate terms down. So you have taken significant steps up here using just purely Consensio. And then here you start wondering, I don't know, we're trying to break the long term, we can't do it. That's a great reversal candle. Here we try to get up, we can't do it. Here, this looks like it wants to go up. Tried to get down and it didn't. On and on and on and on. But you're just setting yourself up. Here the short term turns up, cuts through the intermediate term. I can't tell if the intermediate term turns up here. I don't think it does. But in any case, maybe I put some of that money back to work. Maybe I didn't. It's hard for me to tell now. But boom, everything's out. I'm 50%. Everything's down. Everything's below everything else. I'm not ready for the other 50%, but here I am ready for the other 50%. Here I'm slapping myself. You got to get out of this. It's going to turn the long term down. I cannot tell you if I did or would. All of my clients at this time were institutional clients. They would not let me get out anyway. That's another story when you've got to go back into webinars to hear this story. But here I don't have any individual clients. All my clients are big institutions. They tell me what I can and can't do. One thing you can never do is raise cash. You cannot get out of the market. So anyway, I'm just saying what I am thinking about what's about to happen to my clients' accounts and what I need to do about it. There's other ways you can protect an account without raising cash, and it has to do with sector rotation. We're looking at one part of the market, the NASDAQ. Others are not doing the same thing. Anyway, back here, you're fully back in. Everything is hunky-dory. The long term has moved up again. Short and intermediate term are above the long term at this point. Price is above it, and on you go. All of this action is taking place down, $1,000. We're nowhere near the big run yet. A little bit off the table, more off the table, maybe 25. Long term never turns down. Back in, back fully in, back, fully in, fully in, fully in. Maybe 5, maybe 10. Back in, fully in. Now we're up to 2,200. We didn't know at this time, but we're only halfway to our goal. We're not looking at hyperwave. We're just looking at one very simple tool, Consensio. Sideways, I'm bored, go on vacation. As we get closer on these wicks to the long term, I look at it. Back in, a little bit out, back in, maybe, I don't know. And then boom, now we take the big run. Where do you get out? Using Consensio. Well, definitely here. That's a killer drop, which occurs in March. The peak is in March. What you don't know from here is the Dow and the S&P are not doing all this crazy stuff. Value stocks are not doing any of this crazy stuff. Warren Buffett's apologizing to everybody because he's underperformed the market for 3 years running, big time. because he's a value investor and value stocks aren't going. That's where I hide my institutional money because I can't raise cash when I decide to get out. I'm sector rotating. That's another story, but there are things you can do. It's not all in and not all out. Okay, price breaks down here. Short term is turning down. Short term cuts through intermediate. We got some fives going on here. Intermediate turns down, but that's because of this big bar. Somewhere in this week, you are going to be 25, 50% out as price cuts through the long-term moving average because of the acceleration that this is causing. And you can do your own math and figure out day by day what these things are going to do in the future based on where this price is going in this week. You get a little relief rally, and it happens right at the long-term moving average, which is nice, which keeps going up. But now the short-term and intermediate term cut down through the long-term. The long-term has not yet turned down, so you're at least 50 down in here, and then it throws you another bone and says, nope, premature, we're going much higher again. You get all this stuff, but it's really a flattening, so the long term doesn't turn down until these two candles, and then you get a little bit of a dip in the long term. We're out to July. This nonsense started back in March. The Dow is still going up. The S&P doesn't turn down for another several months. There's a number of stocks in the NASDAQ that are also in the S&P, which is important when you're doing your analysis to know what you're really looking at. But in any case, flattening out, prices back up. Somewhere down in here, though, the long-term turns down. It gave you a chance to get out of the other 50% on one of these candles, still up in the 3,500, maybe 36, 3,700, 100% out. You've been 50% out most of the time. You might put a little bit back in at various runs here, but in any case, very clearly, as this long-term turns down and everything is below it, you're 100% out of X, where X is the amount that you're able to trade in this particular thing. And then you come all the way back down here to 1,300, down here to 1,100, and down here to 900, and down here to 800. Okay, so that is Consensio, and it kept you out. Consensio did, as you see. What the heck is that? It must have hit a button by mistake. Oh, that's Copic Curve. Go away, Copic Curve. Thank you. Okay, there it is. That is the second one we've run over. It's 118. No, that's pretty good. We snuck that one in. Oh, let me throw on stop and reverse points. Let's take the moving averages off. We don't know about moving averages. We don't know about hyperwave. But we learned something from Wells Wilder Jr., a stop and reverse point. And so there it is. Keeps you in the big moves, like Consensio in flat. There's downward movements. You get in, you get out. You got to decide how much you want to do. Catches all the big moves. That killer bar right there, you will see that every once in a while, in which a stop and reverse point gets hit. And that's because this drop was so huge. Take a look at this very carefully. These are not trend lines. They're not moving averages. They are accelerating up and curving. That's why they're called parabolic stop and reverse points. They are designed to get you out and to keep a majority of profit. That's what they're designed to do. Therefore, if you get a huge drop down, it gets you out. And it got you out on this candle, which then put the dot above it. And then this went up so far that very next week it got you back right back in again and started another series to the upside, which then gets broken right on. I want to see where I got this. It is not this one, it's this one. This candle gives you the break and gives you the stop above it. So you're out on this candle. Now, when are you out? Because, well, I'll tell you when you're out. You're out about here. I say that because look at where the stop and reverse points are coming up to this candle. Now, this is not, a stop and reverse point does not, you don't wait for the end of the week. It's a stop and reverse point. So it's sitting there on your books. You put in a stop below your price, and each week you're going to change that as that stop and reverse goes up or down. So you are out here probably well before you would have gotten out on a hyperwave, and definitely before you got out on Consensio. The hyperwave, let's take a look, is right here. Close. You would have gotten out of hyperwave on that same candle, but you would wait till the end of the week. You got lucky because you penetrated it during the week. Let's just take a quick look. No, I'm not going to do that. I'm going to
Hey,
take a piece.
Ty,
Yeah.
are you able to darken your SAR lines or just make them a little fatter?
We've all tried to do that and nobody's got a way to do it. As far as I know, there's no way to do it. But I can do this. I can do this.
I could teach you how to do it really quickly if you'd like.
Maybe we're going to take a break, so maybe you can show me on the break.
Ooh, good call.
Okay, so here's the stop and reverse point. Here, 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 here. I'm pointing to each of these if you can't see them. Which means the next one is here. Or right about there. Remember, they are parabolically moving up, so you can't draw a straight line. It just gets slightly higher than the curve each time. But right there is where you get out. Your stop is sitting there at the beginning of this week on Monday morning. When the market opens, whenever it did, this was the open right up here. You did not hit it on the open, meaning on Monday. Well, you might have. You closed the week here, but you clearly broke this stop and reverse point right there. So that's where you're out of that trade. And these then begin down the other side and will put you back in and out at various times. On these moves up, you'll be in, but on the big moves down, the important moves, stop and reverse is a very powerful tool. Okay, we're going to take a break. It's almost 1:30, and we will come back and we are going to do similar analysis on Bitcoin. The hyperwave in Bitcoin. We're just looking at three old ones to understand how you can overlay things on top. If you know where you're going because of hyperwave, you can make decisions beforehand. And then you use these other tools as you get closer and closer to ultimate turning points or to the vertexes of a hyperwave. Okay, thank you very much, and we'll be back shortly. Okay, we are back. And we are going to go right to screen share. What we're going to do this next hour and a half is we are going to go through, first of all, Bitcoin, because I considered that completed hyperwave, except for mopping up exercises in phase 7. So we will have looked at 3 hyperwaves that I've actually participated in over a period of the last 30 some odd years. And then we are going to go much more quickly using the same techniques with the 14 or so stocks that we looked at yesterday, which we are presuming are in hyperwaves at various stages. And we are now going to say we know these are hyperwaves at various stages. What tools do you use for each of these individual stocks? And to get through that many, we're going to have to go fairly quickly after we get through Bitcoin. But we will be as thorough as we can, showing various tools, some of which we haven't shown yet. And then we're going to, in the last hour or an hour and a half, we're going to finish up that process with these and maybe some other charts that you did not see yesterday. Remember, all we did yesterday is say, here is one way of drawing a number of potential hyperwaves. Some are in 1s, some are in 2s. Some clearly are in 3s, some not so clearly in phase 3s, even some that are in phase 4s, 5s, 6s, and 7s. And we did not look at Netflix yesterday. I promised you we would do that today. So we've got a lot to go over. Let's get on with it. I'm going to share screen. I am going to pick this guy back up. I think that's what I wanted to do. Let me just think for a second. Yeah, that works. And I will make that big. And this is the NASDAQ. Everybody, Leah, is this seeable?
Yep, looks good.
Okay, great, thanks. Okay, now what we are going to do is move this little guy here. Come up here, go here. Go here. What I'm going to do, just for giggles, I didn't plan on doing this, but I'm going to. I remember, everyone knows that I have made public the fact that I've never bought a Bitcoin. And I think everybody on here knows that I did participate in this Bitcoin hyperwave through this thing called GBTC. So I'm going to just take a very quick look at GBTC, which to me was not a hyperwave. And there are people that disagree with that, but I'm going to just show you using Bitcoin, and then we will take a look at Bitcoin itself. Let's do it the other way. Let's do Bitcoin, and then I will show you what I actually traded, when, how, and why. This is the Bitcoin hyperwave. I've got a phase 2 drawn in both red and green. There's no difference between those two lines. I just wanted to make sure everybody sees the fact that this phase 2 line is what finally determined we could not be in a funky hyperwave when we drop below that, which happened to be very close to the 6,000 mark with all of these bottoms over here. So people that have followed me for a while understand that. I'm going to take these stop and reverses off. I'm going to put the moving averages back on because what we are going to do is just what we've done with the last two hyperwaves, the NASDAQ and Japan. We make the assumption we don't know this is a hyperwave. But we have learned a couple of other tools. One of them is Consensia. So if we take the price off because we don't know what this is and we don't care, we have this weird looking thing. And when you go back over here, this weird looking thing called Consensia, we can take it all the way back as we are under what is going to turn out to be phase one of a hyperwave line. We don't know it at the time, but we do know Consensia, and people have told us you should be looking at Bitcoin because this is really interesting. So back over here, this is too thin. If we kept going over, we can spread it out. Maybe, no, because you're at 20 bucks. Okay, forget that. Here's where you get excited if you know about Consensia, which would be 2013, the spring of 2013. All of a sudden, your wavy lines that your computer, you've got a bot that calculates this for you on 10,000 securities and things around the world. And it starts beeping at you because all of a sudden you've got this short term above an intermediate term above a long term. Now I'm not going to change this to a 2. Normally I would use a 2 on Bitcoin and cryptos instead of a 3 because you've got an extra 2 days in there. And a 3 would be more days than I would like. It doesn't matter. Use anything you want. But this thing starts getting interesting. You've got a bull market as defined by price above a short-term moving average, above an intermediate, above a long-term. And so you're going, oh, that's pretty interesting. You know, I'll put $100 in it and see what happens. And nothing happens, you know, through 2013, and we drop back down again and then go sideways. And now you're probably bored with it, but you're interested again over here. Why? Because price, once again, is above short, intermediate, long term. The long term wasn't really moving up through this period unless you took a microscope out, but it kind of was. Anyway, it does start up. Right about at this point, you can sort of see an angle developing on the long-term moving average. Okay, this is great. Bull market, your computer starts flashing, buy, bull market. You've read a little bit about it, but we're still in 2013. So good things haven't really happened. Not many people are in it. Bad things haven't really been too horrible. And you get a really incredible run. And you're above the moving averages the whole time. No reason to get out. Here you get some action, and you might step out of a little of the investment. Here you get some more action. And now things are actually going back down. And so you use your 5, 5, 5, 10, 25. As these things develop, as they cut through the long-term moving average, you start getting suspicious. And basically what you've done is you've dropped all the way down to, in April of 2014, you've dropped down to $400 after having had some wicks up very close to over the 1,000. Doesn't go over 1,000 on a weekly basis on the bodies, but you've got some wicks saying 1,000 is interesting, 1,000 is interesting. Here's again, 1,000 is interesting. So in the back of your mind, you're saying 1,000 is interesting. Okay. And then you give it all back, 60% drop down to 400. And Consensio takes you out step at a time as things are turning down and things are crossing. But the moving average is still moving up. Until over here, it stops moving up, it starts moving down. So somewhere you're 50% out, and then it's going awfully flat here, and the long term is still not really doing anything. I don't know. At some point in here, maybe you're just tired of the whole thing and you get out. Because you're below the moving average, it's moving down, and etc. Okay, I don't mean to be too flip. I just want to get through this fairly quickly. Now, throughout this whole period, it just keeps grinding and grinding and grinding lower. Some people want to say that earlier bump we just went through was a hyperwave. It's got certain characteristics of it. I don't believe it is. I think even though this thing moves at 3 times plus what normal things do, I can't consider that a hyperwave. Things are too short. Things didn't go high enough. The angles aren't exactly the way I like to see them. You can call it anything you want. I'm just telling you that's the way I look at it. And now you finally get to the end of this period of time where it's been grinding lower and just messing around. It turns out that was a pretty big bear market. Tone talks a lot about it. And then we get out of it again. Okay. Consensio gets you back in. The long-term moving average eventually starts moving up. So you've got to break down each of these to see how big are the moves actually and all that sort of stuff. Where are they actually crossing? How much you're doing 5 and 15? That's not what we're really talking about. We want to just see that the long term is clearly moving up here. The price is kind of screwing around $400, 440, but then it finally establishes itself. With these candles, we stop going sideways in terms of price and things begin happening. At 460, we go sideways, but still everything's good. Now we're back up, and now you start getting a spread between the moving averages. And as an investor, that's what you're looking for. You've got plenty of targets out there. This was pretty exciting, running up to 1,000, but then for 3 years it didn't do anything, and all kinds of bad stuff started happening. But here, as an investor, things are getting really interesting with this movement, just looking at Consensio. Not knowing anything about hyperwaves, and we'll look at some other tools, but okay, so then it runs up, and then short term comes down, breaks below the intermediate term, but the intermediate term is still moving up. Then you get all this stuff, including this spike all the way back to 460. These were up at the 700 level. Let's just do that so we can see this wick actually got up to 778. Okay, and then all the way back down to 400, but this is, some people would say, capitulation, the long term is moving up, a great potential turnaround candle. It doesn't really right away, but finally works its way back over, and now you're in the 600 range and you spend months doing that. Then back into a full bull market, only Consensio, full bull market, you get up to this magic 1,000. Well, you noticed it a number of years, 3 years earlier. This one gets up to 1,005. This one gets up to 1,139, but it closes at 909. This one closes at 1,011. This one closes at 1,000. This one breaks above 1,000, closes at 1,051. Now, people ask me, why do I draw phase one at 1,000? And my answer is because if you connect these candles, weekly candles, and run back into history, everything is below that 1,000 mark, except for a couple of weird little candles where you ran up above 1,000, but the bodies of the candles are all sort of below it. And then way back in here, where are we? We're all the way back to 2012. Okay. So that's why I draw my phase one line of a hyperwave at 1,000. People can disagree with it and all that. I don't, that's perfectly fine. I'm just telling you, that's the way I look at these things, that when you've got evidence of a top, and then years later, you've never gotten above that top, and then you work your way up to it, and then find that top holding again, that to me is the definition of a phase one. And a breaking of the phase one at the $1,000 level in hyperwave parlance begins phase two, and which are these lines here that you'll see in a second, begins phase two, and also tells you that if this thing turns into a hyperwave, where it is going to return to. It's going to return to this 1,000 line. That's why the 1,000 line is there. It's not that I like round numbers. It could have been 836. It could have been, 1,327. I don't care. It just so happens that 1,000 was the number that makes sense to me as a phase one, because everything, basically all the bodies of all the candles for the 9 years previous to that were below that number. Okay. Now it all begins, but now we're not talking hyperwave, we're talking Consensio. So what is happening at that $1,000 level for Consensio? It's been going up from 500. The long-term moving average, remember, we're out of this bear market, 2015, and the long-term moving average is moving up, and look what the price does. Now, if the price stays above that all this way, then Consensio is going to keep you in at least 50% and maybe more, maybe 100% at times. Every time you're above, the price is above, you're 100% in. Therefore, on the break above 1,000, Consensio, after this drop, which is above the long-term moving average and tested that long-term moving average with a wick, this break back above in price, Consensio gets you in, and it keeps you in until the sideways market, sideways movement begins. And then you've got 5, 5, and 5s to get you out. Long-term could care less. It's just going to keep accelerating and accelerating. So now you're back into hyperwave, but you don't know it's hyperwave kind of action in price, where you get highs above highs and lows above lows, highs above highs and lows above lows, all the way to the top. And in that configuration, now even though this is a hyperwave webinar, we're talking about overlaying this thing called Consensio on top of it. And in that configuration, what happens with Consensio is you end up just taking a little bit off the table when you don't know what's going on, because you don't know if this is the end of the market right here. It's just had a huge run from 1,000 to 4,800. This might be all, you're happy. So if you didn't know hyperwave, and you didn't know Consensio, you just made an enormous return, almost 10x from $500 in a very short period of time. And so you're scared out with these drops that cut through moving averages, not knowing that this long-term moving average will keep you in, Consensio will keep you in at least half of your investment. But at various times you might take out 5 and take out 5 and stuff like that. Here you don't need to take out anything, even this big drop, because nothing happened. You cut through the short-term moving average, but you just touch the intermediate and then you're right back up again. And the long term is taken out of play. So Consensio going into the top of this market, on this candle, price breaks down through it. That's why I use short-term moving averages. I want signals to start occurring as early as I can. That's why I use ridiculously short moving averages for my short term. 3 weeks, and it would be 2 weeks because of Bitcoin's trading 7 days. But this is a 3 week, and that's good enough. You cut through it right at this point, cut through the short-term moving average. The short-term moving average quickly moves down because of this candle, which also both of these wicks cut through the intermediate. This price action back up again, slows down the short and the intermediate term. This candle turns the short term back down hard, as does the next ones. The intermediate terms here, you're out of 555 at least. You possibly go for a full 25% out, 555 and 10 with this candle because of the depth of it below both moving averages, and during this next week the intermediate terms down. So you're at least 25. You're thinking more than that. You draw even just dopey trend lines, and you don't really see anything. You've been saying, wow, this is stupidly up. So you might have been thinking about, this is one of those weird things that when it goes vertical, I better look for an exit point. But if you didn't, if you were just looking at Consensio, then the cross here is important. Finally, down here where price breaks the long-term moving average and then comes back, which happens to be phase 3, this angle here, which is phase 3, which is why this was such an amazing candle for me, because in hyperwave theory, that could have been holding the phase 3 line, which it did for all of these weeks until it finally couldn't hold anymore and we broke down below it. But in any case, just on a Consensio basis, this starts you lightening up, and now you've taken 25% off the table. In these candles, because this is all coming down so steeply, you are perfectly in your right to take another 25% off. You don't take the last 50 off until this turns down, which doesn't occur until June. But you get out a little at a time, and then when this comes over, you're completely out of it. All right, let's take the moving averages off. Consensio, because of the sharpness of this move, would not have been particularly helpful in terms of hyperwave. Let's take a look at the stop and reverse points. I meant to take these on, and these on, and these on. Stop and reverse points work very, very nicely because they are moving up at such a sharp angle and they keep accelerating up because of the steepness of this curve. They just want to be knocked out, and they are on this candle. You're out on this candle. Now, just as you couldn't really see before, I will do my best to show you. That's pretty good. There's a stop and reverse point. Look how close this one came. It did not knock you out. There's a stop and reverse point. As price accelerates up out of this little correction, these guys begin to accelerate and the spread between them grows. You don't have to calculate that. You just do it using Wells Wilder's calculation, which is on TradingView. You just put that in. So the next one is up right about here if I'm eyeballing it. This one, and this one, and you're out. You're out at 13,514. And now you start down the other way, which you don't know because you don't know it's a hyperwave. And this keeps you out. Take a look at how close it comes here without hitting it. Keeps you out until this 4-week period where we run back up to 8,500. And then you're right back in because of the drop off of 8,500, and you have been out ever since. 4 weeks over the last 14 months. You were not completely out of this using stop and reverse, depending on how much you decide to take off at various times. Everybody makes up their own minds. Okay. So those are some tools that can be used when looking at hyperwaves and making decisions. And I'm going to stop there with the 3 that I lived through. Oh, I said I was going to bring up GBTC. And I'm going to do this because I traded this and I bought this in August, GBTC, and I sold it after this run up in December. Now, how and why did I do that? Well, because I was using Bitcoin as my trigger for this. I wasn't using this chart by itself. But let's just say you didn't know about Bitcoin. You came across this stock. And what you will see when you put the moving averages back on. Nope, we want this one. We want this one. And we want this one. Okay. And take the stop and reverses off. And take the price off. Okay. This is what you see. You don't know if you're looking at Bitcoin or if you're looking at the Japanese stock market. It doesn't matter to you. All you're doing is looking at the wavy lines. And just as we saw in Bitcoin, when this thing goes up, all the wavy lines go up and they are above, above, above and moving up. And it's almost the same. The difference between what we looked at with Bitcoin and this is this will trade at a premium to a discount. And the premium can be huge over the intrinsic Bitcoin. It can be over 100% more in value than the Bitcoin. It averages 40%. For a long time now, it's been trading under 20, under 10 quite a bit of the time. And we've talked about that on various things. But just looking at this as a stock, which it is basically, they call it a trust, but it's a stock traded over the counter. As long as the long-term moving average is moving up, you're in it at least 50%. At various times, you're going to get out of 5s, maybe out of 15 on prolonged things, but right up to the top. And then the same crossover occurs, and you don't get the downturn in the long term until over here. So using only Consensio, you make an awful lot of money, but you get out late. And we figured it was something like 13,000 bucks. But many of you today would be very happy if you had only known Consensio and you followed its rules under all cases. Okay. let's just take a look at the stop and reverse points off of it. So it gets you out right. Now this thing ran up to 40,000, 30, 38,000. At the time of this run up, the Bitcoin it held was worth a little more than half of that. So you made more money on GBTC on the upside than you did on Bitcoin, because the premium ran from 40 to up over 100. You picked up 60% just because of the premium expansion. If you got out, if you didn't get out, the premium went from 100 back down to 40. Now it's at 12, and you lost all of that. That's why you get out of things, including Bitcoin. But for GBTC, it got you out very nicely at 23,000, approximately 25, 26. I was able to sell a lot of mine at between 28 and 32 on this because of a number of things, mainly that the phase 4 of the Bitcoin hyperwave, which is this angle here, was so steep that this is the candle that took us out of the phase 4. Some of these that we've looked at, the SAR is better than the moving averages, which are better than the phase 4 of a hyperwave, but that all depends on that final angle. In this particular case, the best signal you could get was the phase 4 connecting all of these bottoms all the way up with this close below it. The close is at 14,000, but the penetration was much earlier. I wait for the close, so I wouldn't have gotten out on the drop, even though I wanted to. I didn't, but I cheated because I was in GBTC, and I didn't want to lose the premium, which was coming down fast. So I did not own Bitcoin. I did own a lot of GBTC, and I did very well just using these very simple rules. Hyperwave rules are simple, but you can't fight them. Okay. That's what I wanted to cover in terms of old. Now I want to begin looking at the charts that we looked at yesterday. And we're going to end with Netflix. We will just do it in the same order we talked about yesterday, starting with AES Corporation. And to do that, I am going to share again. I'm going to go to this one. That's where I was. I could have stayed there. I'm going to share it. And I'm going to change this over to move this guy over here. Indexes. There we go. AES. All right. Now, the lines drawn on the charts that you got yesterday, I don't have drawn on these, but in the next segment, we're going to bring Socrates back. We will pull up the charts from yesterday. I'm just going to look at the names of the 14 stocks we looked at yesterday, giving you the same analysis that I have just given you for 3 hyperwaves that I participated in and are no longer around. That's why we can get through this fairly quickly. We're not looking at hyperwave lines here. We're looking at charts that some of you that were on yesterday got to see where the phase lines are drawn. and then we're going to make the assumption, just as we did for the Nikkei and the NASDAQ and Bitcoin, that we know nothing about hyperwaves. That's what I'm going to do for the next hour. I'm going to assume we don't know anything about hyperwaves, although we got a sneak peek that all of the charts you're about to look at are somewhere in a hyperwave. And we're going to look at the things we just looked at, which are tools that I like to use. We're going to expand that a bit. Okay, this first one is called AES Corp, Electrical Distribution Company. And we are on the weekly. We got too much going on. Let's get rid of this stop and reverse points for now. Let's only look at, first of all, let's get a running start by looking at the monthly. This is 2007-8. We had this big run up. Now we go through this period of time through 2009. So I'm assuming what we're looking at is a phase one here. If we were talking hyperwave talk, I'm just trying to get my mind around what's going on, plus this breakout above those highs. Okay. So this is a fairly volatile company, and we're looking at it from the perspective of would we be in this thing because of consensus? The answer is yes, absolutely. Right back here, everything becomes fully bullish. Everything still is fully bullish. We would own this on the basis of consensus. Throughout this period, we would have been out most of this using consensus, back in, back out, percentages, flatness. So that's what we're really looking at here with a longer perspective. Why would you be looking at this thing? Well, because from 2009 till 2 weeks ago, this thing was flat and the rest of the stock market was going crazy, right? 2009, 10, 11, 12, 13, right through today. This one wasn't. So that's a great looking phase one that lasted from 2009 through 2014 to today. That's a 10-year, 9-year phase one, and we just broke out. So why are you interested in it? Because you just broke above a horizontal trend line. We don't know it's a phase one at this point, and we're not thinking hyperwave. We're thinking this is a great little buy. So I can't give advice. I can only make observations. You are considered the public. But I'm just saying that forgetting everything else, take a look at AES. It's breaking out above a 9-year horizontal trend line. And you're learning something about a system that is very interested in horizontal trend lines. And we haven't lost anything. And Consensia was saying you should have been in this baby for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. So depending on what your financial situation is, I would take a look at this. Okay. The only thing else I'm going to do some other things on all these charts. First of all, we always have to get rid of price. Don't marry the name that you're looking at. Don't marry the price or the fundamentals. Get rid of them and just take a real hard look at what you're looking at. A long, long period of sideways movement, a couple of attempts to do something, long-term moving average turns up, gives it all back. Long-term moving average moves down. Now you accelerate. Look at the difference between the acceleration here with the moving average moving up and the distance these are above that moving average, bigger than here. So something new is going on. And when you go back long enough, you say, wow, this thing has the potential to do some crazy things. Maybe even earlier hyperwaves, looking very quickly at that. But regardless of that, okay, price back on, stop and reverse points. Moving averages off. Kept you out. In, out, in, out, in, out. Sideways action. Obviously in. Tried twice to break it here, didn't, and now it's really pulling away from it, which is going to get this thing to start accelerating. And when it does, the price has got to keep going up or this will knock you out. But that's kind of interesting. I'm going to do, let's put the Copic back. Yikes. That means what? Which is it this one? Yes, it is. Copic. Here's the zero line on the Copic as it goes above and below it. Now we're really accelerating higher, higher, higher than any of these lows since the runoff. So this is, from a technical point of view, this is looking really good. All we know from a hyperwave point of view is that, wow, this could be a 9-year phase one. Let's put it on our list as something to watch for the next 10 years because some big things might be happening. Way, way, way too early to make that conclusion, but we could look at RSI and other things, but since nothing's really going on there, let's move on to the next one. And somehow, how did that guy get up there? I wanted him down. Is it that guy? Nope. No, okay, no problem. Okay, the next one is Lamb Research. Stop and reverse got you all of this, got you out, and right back in, but then got you out again. You've been out ever since. Looking pretty toppy from a stop and reverse point of view. So let's take a look at some other things. Let's take a look at the moving averages. So down at $35, a move starts. Moving average begins to accelerate up. You're fully in. Some fives, but nothing critical because you don't get below the moving average. All in. Some fives. Intermediate turns down 5. Go below the long-term moving average. Price obviously bounced right off of it, but anywhere from 25 to 50% out in the first fives, and then the next to 25. I probably wouldn't have gotten out of another 25. I'd be 25% out as it was testing this soaring moving average. The assumption with the soaring long-term moving average is it's going to hold the short term and the price. Let's see if I'm right. I have not examined any of these charts since yesterday when Socrates made them available to us. Yeah. So even though the moving averages and the price breakdown belong the accelerating long-term moving average, it's now turned around and we are soaring above it. Now, the question is, when and how are you back into it? Short-term bottomed
Hey,
here.
Ty,
Yes.
you're on the monthly.
I wonder what changes that. We were on weekly. Weird. Okay, thanks. Somebody write a letter to TradingView. Okay. Okay, beautiful. Yeah, completely out off of that top. Long-term moving average moving down. Everything down. Tries to test, it doesn't work. Completely out, 100%. Down to the bottom. Below, below, below. Until this price took off. Where do you start buying? You start buying when the price turns the short-term moving average up and the short-term cuts above the intermediate term on this candle. Probably 555. Right here, the intermediate term turns up, definitely 555, thinking another 10. Here, you cut back above the long-term moving average, at least another 10. You want the long-term to move up, but the price is so high above it, it's going to start soaring because the short and the intermediate term are already above it. So somewhere on this candle, you are 50% in, and somewhere in these two candles, you should be 100% in. Amazing turnaround. And amazing how the long-term monthly is just getting the crossovers here. So this could potentially be a very, very big move because not only has the weekly already gotten you in, but the monthly is now verifying it. So that's very interesting. Let's look at the weekly SARs. You've had 1, 2, 3, 4 weeks up. That means this is the week that took it out, and it took it out right here at 152. So you got out of the shorts at 152, and you went long 152 off of the stop and reverse points, and it's now up to 181. And it's moving so fast, it's going to take forever for these to catch up to it, unless the price goes sideways or down.
Tyler?
Yes.
I'm going to ask a couple live chat questions as well.
Right.
Is LAM in a hyperwave?
Let's zoom out and just give a quick analysis. That looks like a phase 1 to me. Comes all the way over here. This is the breakout, making this the phase 2. Making this, well, now we got to sharpen our pencils. And we will examine the phase lines this afternoon specifically. But it's clearly a hyperwave. The question is, where is it and what phases are they? but I would say that after that breakout, that looks like a 2, which is very steep, which could mean that the 2 is actually back here, and this is the 3, and this is a 4, in which case the 4 is broken and we have gone to a new high above the 4. So we'll see when we take a look at the actual phase lines in the next segment. But something very interesting is going on there, obviously. Okay, so I'm going to take those off again. We're back to the weekly. And I'm going to take the step and reverse off. And we're going to pull up 3M. I said yesterday, this is one of my favorite companies for personal reasons. So we're watching this thing very closely. Where would I be in terms of if I did not know about stop and reverse or hyperwaves? 1, 2, and 3 weekly. In for almost all of it up to the top, besides the little 5s and 5s. Now completely out of it at this point. So the question is, when we look at this, is this a 3 over here somewhere, or was this a 4 that's broken and we're starting the downside? But we're not talking hyperwave. Consensio has gotten you completely out of this at this point, and you are still out of at least 50% because this is long-term's not moving up yet. But there have been a couple of occasions where it's attempted to, moving averages have gotten back over the long term, but then gotten knocked back down. Right now, it's too early to say, but it could have bottomed the way the S&P could have bottomed. So many other stocks could have bottomed back in December and are reestablishing themselves above all the moving averages. And so the question remains, does the S&P break out to the upside here or down? And I'm saying S&P because so many charts look just like the one we are looking at now. 3M is in the middle of all of it in S&P and one of the biggest companies with the longest history. So it's going to act like the big indexes. And I think it's too early to make the call. On a consensio basis, it clearly is. You do have a crossover of the short above the intermediate, but they really haven't crossed the long term yet. We're in that area of resistance that so much is we're looking at right now. Let's see what this, if the SARs would have gotten you out of that. Why does that keep doing that? Stop it. Okay. I'll leave that up so I don't have to keep clicking off things. There's the stop and reverse. Got you out really quick. Kept you out. Back in, out shortly. It's still out until last week. That's interesting. Just as we're trying to figure out on so many things, is this for real? The stop and reverse has been taken out after 1, 2, 3, 4, 5, 6, 7 weeks, and is now supportive. And all we need is another week, and it'll be fully bullish if we hold where we are or go a little bit higher. Okay, this is good. Here's the RSIs. I wanted to pull those up on the others, but for some reason they weren't there. One thing I didn't show you on the Nikkei, on the NASDAQ 100, and on Bitcoin was this action that takes place at the top of all of the hyperwaves that we are looking at. Assuming that this is a hyperwave, you can see how overbought it gets at the top and has never gotten oversold at the bottom. I'm going to just really quickly, since I've got that up, pull the NDX up. Go back monthly. Here is what happened running up to the top of the hyperwave, which looks exactly like Bitcoin. And here in 2009, it finally got oversold at 30. That's a monthly chart. Very difficult to get a monthly chart oversold, even though it had gotten way overbought. But it did get oversold on a monthly basis. On the weekly chart, this is the peak in 2000. Here, does that automatically switches to the monthly? That's very irritating. Okay, here's the peak in 2000. Going up to it, all of this is wildly overbought above 70, above 75, above 80. A couple of these are over 85. And Bitcoin looks exactly the same. Both of them are hyperwaves. We have come down and breached we went to 30 on Bitcoin. And I said, I think it's got to get a lot lower. These got down to 25 and 26. And finally, in 2009, to 19. That's oversold, correcting this. Okay, so I just want to show you one other thing very quickly, which is right here. Here is the hyperwave on the Nikkei. 85, 80, a bunch of in the high 70s. Here is what you have to do to unwind that. 21, 24, 25, 22. I don't say that about long-term things except for hyperwaves. The reason I've been so adamant that the bottom is not in from a technical basis on Bitcoin is because that RSI shows that there has not been capitulation, even at 3,180 or whatever the number was. There it is right there on a weekly basis, a 28. On one occasion, try and look where that occurred. It occurs, of course, right at the bottom candle at 31 to 3200. So what we are going to see, in my opinion, is the reversal of this. Not just popping up to 70 and getting overbought, but screaming above wildly overbought territory. That's what a hyperwave does on the upside. And it does exactly the same on the downside. Okay, back to business, which is back to this. Okay, we did 3M. Let's do a biomed. Let's bring this down where it belongs. This is a biomed. We'll take a look at the phase lines off of the other charts that we have. But for now, you can see what happens with stop and reverses all the way up, getting you out fairly early. Long-term consensio here turns down 100%. And now, just like what we saw with 3M, this attempt, along with 4 weeks up on the SAR, to get back above the long-term moving average and give it time for the short and the intermediate term to catch up and give buy signals. So it's in the exact same position. You can see that this is hyperwave-ish. And otherwise we wouldn't have used that chart that we did yesterday. There's the 1 into the 2 into the 3, the 3. This is interesting that this broke down, which could mean that the 3 is still intact. And I don't want to look at the phase rise. I'm just looking at what these other signals are telling you about this formation. So when you do look at the hyperwave things, it gives you the additional information for you to make your final decision. And you can see that there's nothing oversold here coming off that. This is 40 on the bottom here after being way up here at 90 on the way up. So if this is breaking down out of a hyperwave, which we will take a look at in the next hour, then it's got a long ways to go. If it is actually holding 40 for the RSI, which sounds more like holding a phase line, which means that that initial pop-up to the top there was not a 4 breaking down. It was something else. So we will examine that in our final hour when we put all of this together. Put other tools, and we're going to add one other tool that Socrates is going to talk about. I mentioned it yesterday afternoon, having to do with playing hyperwaves by using prior highs to set stop limits. Okay, I want to take a quick look at Kimberly Clark. Get rid of this. It's been coming down for a long time. Make it bigger, see what we're looking at. There it is. huge run up. Okay, so the question is, are we in or out, not knowing anything about hyperwave? We're clearly out throughout this whole period. Long-term moving average has stopped going down because of all this activity. Are we in long? Short above intermediate. Intermediate is still not turned around because of this big red bar. Seeing a consolidation right below the level at which, if the markets break to the upside, this is probably going. The long-term moving average went flat, now is moving up. December, January, February have been very important for the U.S. stock market. Kimberly-Clark falls into that category. Stop and reverse, as you can see, have generally done what they need to do, which is on the way up, you get big long runs, and then it takes you out, and it takes you out very close to the top, within a bar or two of the top. Going down, the same thing, unless you're interrupted. All the way down takes you out just about at the bottom. Very, very powerful, handy tools to have in your tool chest, just as a way of double checking bigger things. Okay, APD is air products and chemicals. We looked at this yesterday and we were kind of blown away by the chart. That's pretty amazing. So where 3M and a bunch of these others are not breaking out yet, this one is breaking out of this huge consolidation that's been going on for in 9 months. And we are at new all-time highs on that. And of course, we're in it long-term moving average moving up, all the others above it, price above it. So we're 100% into that. Wow. Let's get rid of the stop and reverses. Let's get rid of the price. What a run. From 75 to 140 since 2013 to 2015. And then that was wicked. 2016 and 15 really hurt a lot of people. You're back in with this turning up right there. Okay, back on. Very interesting. Amazon. We looked at the chart yesterday, and it's clearly in a hyperwave, not even drawing any lines in it. The question is, how specifically can any of these other tools help us figure out, are we just coming down to a 3, or was this a 4, 5, 5, 6, and a 7, starting a 7? When we pull up the chart, we'll take a close look at that. But according to Consensio, at this point, you're fully out. All the action below it, this little bounce, you might put a little bit in, but I doubt it. So Consensio is saying you should have been out. You would have started taking it out up here. on the crossover of the intermediate and the short to the longs. Basically, you're completely out down in here. So stop and reverse. Once again, get you out at almost the absolute top. Let's just assume for a second this is a 4. Stop and reverse. Looks like it got you out a week or two before you would have gotten out with hyperwave. So a great tool in certain kinds of markets to help you make a decision of what to do with your portfolio. It's really, oh, I see what the problem is. Okay. Amatech, working on a broadening top. If this gets higher than this, you've got a 5, 4, 3, 2, 1. In fact, you've got a 1, 2, 3, 4. No, it's still a 5, but it's not there yet. Moving average has gone flat to down. And all of this action basically is Consensio has you out with this downturn right here in the long-term moving average because all this action is below it. Now we're trying to break back up to the upside. Short is above intermediate, is above long. Intermediate is not above long, but intermediate is moving up. So it looks like it's trying to reestablish an upside, which could very well mean a new high that would then be this thing called a broadening top, also called Seligman trading system. And the stop and reverse is you get whipsawed over and over, but up here again, you're out pretty early. Well, maybe not until this one, but in this trading range up at the top. So we need to take a look at that one from a hyperwave point of view to see if any of these additional things would have helped make decisions of when to get in and when to get out. The big thing we want to do, though, is assume all of these are in some phases of a hyperwave beyond phase 2, so we can talk in our last hour and a half about decisions that you make in these long-term upswings instead of just holding them. Are there times that you can take advantage of the distance you get above the long-term moving averages to take profits? And the answer is yes, of course. Using one thing as parabolic stops, and you can increase the speed with which that parabolic move moves up to protect yourself by getting you out earlier and earlier. Or we will take a look at how far above trend lines or phase lines, particularly 3s and 4s, you get before these corrections take place that bring you back down to long-term moving averages or to phase lines, where you should either be out waiting to buy back in every time this comes down to these long-term moving averages and find a level at which that you believe that it's overextended enough that you don't mind stepping aside and maybe letting Consensio, instead of going 5, 5, 5 out, you go 10, 10, 10 to accelerate that pace. We'll talk about that in detail off of these same charts, but with the phase lines drawn on them. Okay, this is Abbott breaking the new highs. We saw Kimberly looking really good. And okay, so let's take a look at Boeing. We talked about it briefly yesterday. This remarkable new move. And It's clearly not over. The question is, where is it moving from? Where would you be in and out? You're fully in Consensio. You're in with stop and reverse points for the last 5 weeks. Relative strength is, that's very interesting. That after this huge thing, it, like the other one, only dropped to about 40 before moving back up and is quickly becoming overbought. But if I had to guess, we're going to get back up into the 80s and 90s on the upside here. Honestly, it's oh, I lost all that stuff. Okay. Um, what I am going to do is I'm going to go here and here and here. I messed all this up. I must have hit the wrong button somewhere. If anybody can see what the heck it is that just happened. Um,
They say just double click anywhere on the chart.
nope. Oh, there it is down there. It switched places. Put the RSI on the top. Okay, good. So we don't really want that. What we want is, we were just looking at Abbott and breaking to new highs. Boeing, we looked at breaking to new highs, which should get some of us enthusiastic about this week coming up in the market. ATBI, okay, that's horrible. Fully bearish. Question is, where is it? Is this a trend line that was broken? A phasing? Maybe. Apple, fully bearish. 3 weeks up on the stop and reverses, but long-term moving average moving down. So that'll be interesting to look at. The RSI did get oversold here a bit right at the bottom. That's interesting. Okay. Just take a quick look at GE. 8 weeks in a row. To the upside, you need to break above that long-term moving average, which is still moving down. This looks, a little bit like what we saw at 6,000 for about the same amount of time on Bitcoin, the plunge, but this one's moving up and Bitcoin isn't. And we said the target on this, I believe, was like either 2 or 5 off of what it looks like. Let me just go monthly real quickly. Most amazing charts there is. We've taken out that low. And so if this is the phase one, yeah, it's could drop 80% for here if it's going to hit phase one, which it has not yet hit. If this is all part of the phase seven, first of all, it shows how long a phase seven can go on forever, driving everybody nuts. That's just unbelievably unusual. So we picked out some very difficult ones to analyze. This one is the one that we said we will go into some detail today because we didn't get to it yesterday, Netflix. And the question is, where is it? Is this a 4, 5, 6? Or is this still part of a 3? And that's what we're going to look at this afternoon, using these other things to help us make that decision. The stop and reverse is negative, and it's coming down. We came right up to it last week without breaking it. If we just sit right here, it will break this week and become positive beneath it, which means that 6 might have a ways to go. If we get a negative candle starting at the beginning of this week, then the stop and reverse can chase it all the way down much, much lower. So this, to a lot of us following the hyperwaves, is one of the more important charts because...
Ty, that's on the monthly again, just letting you know.
Yeah.
Cool.
Because it is so reflective of the FANG stocks. And therefore, what the FANG stocks are doing, if this is actually holding here, and we will look at it very, very carefully this afternoon, then it could be that this is a real move going to new highs. Now, on the stop and reverses, you've got about 7 positive weeks. You've taken out the downtrend line, which has not yet turned up on the long-term moving average, but both of these have turned positive. So if you're playing this as a 6, it's still in a 6, and you've got the possibility of it going to new highs, which means this was not a 4. Is there any way to tell before that? Well, when we pull up the Netflix chart with the lines drawn in, we will critique that very closely. And then that is it for the charts that we had. We've got a bunch of other charts: Citigroup, the Russell 2000, Caterpillar, VLA, McDonald's, Nike, and Amgen. We're not going to get to them, but we will give you a list of them with some charts at a later time. What we're going to do now is we're going to take a break away from these. We are going to bring up yesterday's charts on these same 14 positions we just quickly looked at, looking at RSI and stop and reverse and Consensio. And we will superimpose the phase lines on them and then do very specific analysis on investing in them right now, regardless of exactly where they stand. So with that, I'm going to stop share and I shall be back. Thank you.
Boom. All right, part 3. We got Socrates.
Welcome, Socrates.
Thank you very much. I really appreciate you having me on and for all the nice words you've been saying about me. It truly means a lot.
I don't mean any of them.
All
I
right,
mean all of them. What I want to do getting started here is I knew we were going to run out of time. I apologize for messing up so many of those charts. most of them are unimportant from this perspective. Hyperwaves are real. The bigger the hyperwave, meaning the big indexes, the more important they are. I showed you the Japanese index, the Bitcoin index, and the NASDAQ index as examples of three that I lived through. The one we are talking about now, these individual stocks are fun and they're interesting, and you can do very well with them as long as their superiors are taken into account. And that's why the last year and a half has been so important, because it appears there could be a turning point on these very large indexes breaking down. If so, all of the ones and the twos and the threes that we're looking at are going to fail. Many of the threes are not going to go to fours, fives, and sixes. They're going to become part of 15 percenters. There's not a lot of threes, but there are some that might be fours. There might be some that are fives. We've got things like Netflix, Amazon, Apple, but those are peripheral to the big indexes. Start with the big indexes in your thinking about hyperwaves. Think about those things that are most related to the macroeconomic issues. And the one that we have identified is debt and credit. And that is a long topping process that after an 80-year bull market and bear market hyperwave in the 30-year US Treasury has indicated that that hyperwave is over and something new is beginning. We don't know what it is yet. There's no way to tell. But we're getting all kinds of indications that it is affecting many, many individual sectors, industries, and individual stocks. Don't get hung up on the individual stocks until you have got confirmation on the next level higher industries and next level higher sectors and next level higher the overall indexes that encompass all of them. They will determine all of your decisions in hyperwave about everything lower than they are. And the big debate that has been raging for the last year and a half is, which way is this thing breaking, to the upside or the downside, meaning the US economy and US stock markets. We are now going to go in the last hour or hour and a half or however long it takes to do the job right, looking at the sprinkles on top of the icing on top of the cake. But many sprinkles happening at the same time can totally cover the icing, which can tell you something about maybe what kind of a cake you're about to eat. And therefore, going right at the micro level, as we are doing on these 14 or 15 stocks and another 50 or 100 that we've identified, it's very critical for us studying hyperwaves to get a sense of what they are doing, to give us a clue of the next bigger and the next bigger classification of importance of the securities. So I'm going to turn this over to Socrates. He's going to bring up the charts that we were looking at yesterday with their phase lines drawn on as closely as he and I have been able, along with help from a lot of other people in the research group, to draw. And believe me, within that, there's a lot of debate. And as you look at individual stocks, where phase lines are drawn and when you need to shift them becomes a matter of debate and opinion. what should not be of debate in your mind any longer, that these things are real, they are very powerful, but there are other technical tools to help you make decisions at all levels, the smallest level, the stocks, the next biggest levels up, and all the way up to the indexes, which will help us over the next year, 3 years, 5 years, 10 years, have a real clear sense of where investment dollars should or should not be. And with that, I'm going to turn it over to Socrates.
All righty, thank you very much. So yeah, just the first point that I wanted to make is after learning hyperwave theory and seeing a bunch of nice charts and seeing Tyler kind of go over them, it can seem like it's pretty darn straightforward and easy to do in real time. And I want to distinguish drawing hyperwaves versus trading hyperwaves. And that is something that you will find out anybody who attempts to trade them. It's two very, very different things. Looking at hyperwaves in hindsight, you see the archetype, you've seen it over and over again, you've seen 5, 10, 20, 50 of them, and it becomes pretty darn easy to follow the rules and draw a nice, pretty hyperwave. However, when it comes down to the time to make a decision of when I'm going to enter, that is when it really comes to life. And that's where it's very important to use all of the tools that you have at your disposal. And I have found there to be a handful of tools that I think work, complement hyperwave better than anything else. And just a little bit, I guess, about myself and how I found Tyler was in 2017 when I was getting really into Bitcoin and altcoins. I was looking at a lot of charts, looking at long-term charts, history, and seeing this repeating fractal, this repeating bubble, Wall Street cheat sheet type of move that just was repeating itself over and over and over again. So I set out to try to figure out how am I going to be able to make money off of these? How am I going to be able to trade them? I didn't know Tyler yet, and I went to Google, went online to see what is out there for trading in these parabolic markets. And there really is not much at all. I was really blown away by how little there was out there about trading in parabolic markets. So that's where I became very drawn to Tyler very quickly when he was outlining this game plan of here's how you do it, not just how you kind of recognize the different stages, but here's how you actually enter and here's how you actually exit. So that's, I glommed onto that very quickly. But before that, I kind of had a few of my own rules that seemed to work very well to kind of help me recognize parabolic markets and when they are getting ready to advance. So if you guys want to let me screen share, I've got some things I would like to show. And just tell me when it is on screen share. Am I sharing my screen?
Nope.
Not yet?
Not yet.
Oh, I guess Leah's not going to do it for me. I got to figure it out. Okay.
Right at the bottom of the screen, there's a green box with an arrow. It says share.
Okay.
But there we go.
There we
Looks
go.
good.
All right. So the only thing that I really found when I searched before finding Tyler was this article. It's actually a series of articles on Medium that I can link to that are written by this gentleman, Pethuel Pomoloy. I'm not sure how to pronounce that. But essentially, it is describing a system that was developed by, I'm assuming, a gentleman named Spyfrat. I have tried to figure out who that is, and Tyler might know, but the only first name I could find is him being called Cutie Spyfrat. Does that ring a bell to you at all, Tyler?
It does not.
All right, yeah, very interesting. So I'm not even sure who this is, but there was this seems to be one of the only other systems for trading in these type of markets, and I think it can be very useful. So this is something that we'll just very quickly talk about. I didn't have time to find to add these to the charts, but this is something that you guys can maybe check out and see if it's something that you think would be worthwhile, worth using. So basically just 5 things right here. The RSI we're looking at, instead of the 14 period, we use the 30 period. And for anyone who is unfamiliar with that, I'm just going to show you very quickly how you can change that. So we pull up the RSI from the indicator list, and we go to the settings icon. Let me just make this full screen. Click on that little gear right there, and then we can come over here and type in, instead of 14, we type in 30. And I always just kind of change the color just so that I know which period I'm looking at. So instead of the 14, we're using the 30 period RSI. If 30 period RSI reaches 70 level, stock is in parabolic status. However you want to define that, you can start to study. Does it happen in phase 3? Does that happen in phase 4? This is something that you just might want to start checking yourself and seeing what does he mean by parabolic status. The best setup is when both weekly RSI and daily RSI reaches 70 level, with the weekly RSI value greater than the daily RSI. So we've got, say, the weekly at 75, the daily at 70 would be the ideal setup. And this is meaning that the RSI enters parabolic status first before the daily. Next step down is if both weekly and daily RSI are in parabolic state, but the daily RSI overtakes the weekly RSI value, the stock is said to be in a parabolic high-risk state. This signifies that the stock is at high risk of a major correction, what they call a paraburst. So to me, that is phase 5. And this can maybe help us identify when we are in phase 4 versus phase 3. If it's in parabolic high risk state, to me that provides confirmation that this is a phase 4 move. If both weekly and daily RSI enter 80 level or more, regardless of which one is greater, regardless if it's weekly above daily, the stock is said to be in extreme parabolic high risk state. So basically, that's just a quick outline of how to potentially adjust the RSI and use it more effectively in parabolic markets. So that was the first thing that I wanted to cover really quickly. He also goes over a full trading system in terms of how to trail stop losses. He uses an 8% trailing stop loss. So anytime that it gets into a parabolic state, he feels confident that it shouldn't retrace more than 8% without it entering basically a phase 5 move. So this is something that I find very interesting. He also uses the 10-period simple moving average as a trail stop loss. And he doesn't believe that that should be violated, that there should be a close below that and the parabolic move should be over if it does. So this is something that is the only other thing I've really found that starts to help us understand how to trade in these markets outside of what Tyler has been teaching us. So next, I wanted to just briefly talk about the podcast that I was on with Tyler. I went over one of my primary indicators that I had kind of come across myself to help me understand when there was a parabolic move occurring or advancing, and that was by drawing these horizontal support and resistance lines and waiting to see when it did not come back to test. So since that's already out there and I already spoke about that, that's for free on YouTube. Go ahead and go find that. I didn't really want to rehash that because I've actually got an even better indicator that I have never shared with anybody else. And I feel like now is as good a time as any. And this has been one of my best ways to help me understand when we are getting ready to go on the next level of a parabolic move. So basically what I like to do is draw channels for the phases instead of just one support line to add a parallel line on top. Even if there aren't any other places of, even if it only touches one place, that's okay with me, because I just make sure that this is parallel, and then I can put it right on top of the area that basically I would consider the top of the channel. And when it breaks out of the top of that channel is what indicates to me it is ready to go on to the next phase. So this is something that can be done in real time. Once you have identified the phase line, draw a parallel line to it, and then add it to the kind of peak of that phase. And then you see once it breaks through that, it's kind of indicating, okay, we're ready to go off to the next phase. Even though this one returned and retested the horizontal area, I was still able to recognize it as progressing in its parabolic move because it had broken through this top of this channel and supported it on the pullback. And right here, it became a very high probability opportunity for me to go ahead and expect this move to accelerate. So you see that there. Let's go ahead and take a look at phase 3. We draw our parallel line, and I just like to keep it cohesive with the colors. So we move that on up to the kind of highs, and this one actually works out a little better. You notice how it is respecting that. This is more of a channel. It has multiple touch points, opposed to phase 2 just had that one touch point. So here we see that once we get, and I have noticed that there's going to be a lot of volatility when it tries to break out. So right here we've got that close above, which could make you very confident it's getting ready to make that next move, and boom, you get this huge engulfing candle that could absolutely scare you big time in if you're trading this in real time. So definitely expect some volatility to occur, but once it confidently breaks, then I am very confident that that's just going to keep progressing. So essentially, once we see this next close above, broke this all-time high, and then boom, we're off to phase 4. So this has been an indicator that is very powerful for me. We're going to go ahead and take a look at a couple other charts. And this is the Turkish lira, which I have been actively trading. It is one of my favorite current hyperwaves, just because it meets all of the guidelines so nicely. And this one really is a channel. This would be much more easy to identify in real time. So basically, we're drawing that parallel line there, move it on up here, and I don't have the same sort of stipulations like Tyler, like rules where there needs to not be any close above or anything like that. I'm just trying to get a feel for where we are at in the market. And you kind of see that this volatility happens. We're breaking through it, and boom, we make a big move. We might be very confident that this is getting ready to really make that parabolic burst, that phase 4 move, but nope, it doesn't. It really comes back down. But then again, it is unable to come back and retest this old all-time high. So we should really be on red alert that this is absolutely ready for a parabolic advance. We kind of see this cup and handle action where the ice line just lines up pretty nicely with the top of that channel. And once it breaks through both of those, supports it right here on this kind of pullback, and then we're off to the moon. So that is another pretty good example of that there. And then trying to take a look at some charts in real time to understand how this could be applied. And this is the chart that really is bothering me more than anything else. I'm really troubled by this chart, and this just isn't a phase 4 move to me, but I don't know how else to draw it because it, with conviction, broke through the top of my channel and advanced hard after it. So here I would probably be putting it here, and then we see that volatility, head and shoulders action, find support, So, and then it breaks through the top of my channel and makes a hard move. We're looking at 45-degree angle here. I mean, this is a big move. So let's maybe throw on the 30-period RSI, see if that can provide any help, because this really has troubled me. And I really want to label it phase 3 if it didn't bust through the top of this channel, because this just isn't really a phase 4 to me. The gains aren't really there. The angle isn't really there. There's just a lot about this that is troubling me. So this is one that would be a very good one to use all of the arrows in our quiver, as Tyler likes to put it, and I like to copy, to try to just get our best understanding of where we're at. So we go ahead and throw on the 30-period RSI. Did this ever reach the extreme high-risk state? No, it didn't. So that tells me that provides kind of further confirmation that this was not phase 4. I would really expect phase 4 to get up closer to 80 on this RSI, and it didn't even get over 75. So to me, that's further confirmation that this was not phase 4. Whereas this is my strongest tool in real time that wants me to label it phase 4. This says, no, it's not really, and the look isn't really there. So I'm kind of inclined to believe in the RSI, and I'm not really wanting to label this phase 4 just yet. So something else we could potentially put on, I prefer the EMA myself, just to kind of get an idea. Was this always staying above the 9 or like the 10 EMA in this kind of parabolic burst that I want to label phase 4? No, it's really not. So that provides me with further confirmation that no, this was not really a phase 4 move, because it didn't stick above this 10-period EMA. So that is one that I find very interesting, in that I've never really seen this before, where it breaks through the top of my channel with conviction, makes a big move afterwards, and then doesn't enter the next phase. So this is one that is troubling me, but I'm very interested to see what is going to happen next. There are too many other good opportunities to trade that I'm just staying away from this, but keeping a very close eye on how this is all going to resolve itself, essentially. So the next one that we can look at is the NASDAQ, which is a very...
One second.
Yep.
Tyler, were you about to say something on the Apple chart?
No, just that this is terrific. Keep on going. Every tool that you can use, first of all, you've got to understand that these things are real, and then you've got to try to separate those that are not working the way the rules show that they should be working. You have to bring in other tools to see where you are. I compare it to the difference between VFR and IFR in flying, which are visual flight rules, and IFR, where you're using instruments because you can't see outside the cockpit because of either clouds or fog or something else. When you cannot see clearly, you've got to go to other instruments to see where you are. And that's exactly what Socrates is now showing, is things that he has been using real time, not necessarily with answers, but with posing questions about assumptions that we're making. And that's unbelievably important. So please continue.
All right. Yeah, that was a great analogy. Okay, so here we're taking a look at how this would apply to the NASDAQ. At first, I would be inclined to put this over here, and you see the volatility while it tries to break out. It does break out. It supports the throwback. I would expect the next big move to be off, but it doesn't. It kind of does something similar a little bit to what we're seeing with Apple, in the sense that it does make a move, but not a next phase move. and then it kind of rolls over and finds support at this at our phase line. We're drawing this as phase 3 of a funky hyperwave. So now that didn't really work, and it didn't go off after breaking through, that tells me that, you know, maybe this needs to be a little wider. So after we have more information up here, we adjust that. And that is essentially what I'm expecting to do with Apple here, is basically adjust it up here. That's what I'm thinking. So that is what I would have done. That is what I would have done here, where we had it here, it broke through, it moved, it kept going, and it accelerated a little, but it didn't enter the next phase. So
it's very interesting to me that the confusion on this NASDAQ 100 right at that point where you were expecting a move up was occurring exactly at the peak of the last hyperwave.
That is definitely, yeah, sure enough. Absolutely. Right. I did not notice that. Very interesting. So yeah, go ahead and just kind of adjust that up a little bit. And then this is what I really like to see here. It kind of works this time where we struggle. There isn't that much volatility. It breaks it, supports it on some red candles, and then boom, it accelerates to the upside. And also just kind of interesting to note that it did end up finding support at the top of that channel. So if we just think of entering the next phase and how support becomes resistance, this is something that I really, really like to see. On this big sell-off, it could have easily come back down here at a minimum. Like right here, we've got this unfilled horizontal gap that I like to watch out for. As long as it's not filling gaps on the corrections, then it's likely like a parabolic move opposed to a linear move. So this is something that is really, really interesting me in the sense that it got through the top of the channel here, and then it supported it on this big pullback, and then basically seeing this V bottom, this huge, huge bounce off of an area that not only didn't fill this gap, but also turned resistance into support. So this is a very interesting chart to me, and makes me very confident that we are going to potentially enter phase 4 in the major indices. And I would wait to say that until we make a new all-time high. If this comes down, finds support here, and then takes out this all-time high, I will be very confident that that is an indication of phase 4 coming on. Of course, I would want to confirm that with everything I have found useful in the past. So we would take a look at the 30-period RSI just to see if it's given us any confirmation or any reason to be wary. And we see here, never really reached 80, kind of confirming that that wasn't a phase 4 move, which never really looked like. Let's go ahead and take a look at the daily. Just because that is something that strategy takes into account, and it's still way down here. So basically what I am watching for is for this to break through all-time high, for the weekly 30-period RSI to break 70, and then the daily 30-period RSI to follow. If that happens, that's going to be a very strong indicator to me that we are in for the next leg up, the next phase, the next angle, whatever you want to call it, and I will be betting big myself. So that is something I've been keeping a very close eye on as of late. Something else that really interests me.
Would you draw the phase 4 on that NASDAQ chart from the bottom of your channel back in 2016 through this new low?
From the bottom of my channel in 20...
Right there. Would you draw that?
If this makes a new high, that's exactly what I would be expecting. So let's just kind of see what kind of angle that creates. And it's not... yeah, I mean, that seems like a pretty... and we could even make that a little more pronounced based on that close. Let's go ahead and put that there.
connect to the close here, or that's the open, that's the close there.
So that, to me, it's not quite a phase 4 angle, you know, like compared to what we had here. That I wouldn't be so inclined to. I think what I would be looking at is a new all-time high, and then the pullback from there would be hopefully a steeper angle. If it shot through the all-time high, pulled back, and didn't retest the old all-time high, then that would be further confirmation and hopefully a steeper angle. That, to me, just isn't quite steep enough. What do you think, Tyler?
I'm not sure. I'm just thinking that this pullback is hard to. The recent low is a perfect place for a phase line to occur. But if that's the case, well, I guess the only other alternative would be to go sideways all the way to the phase 3 through the pink line and hold on the phase 3 line before it starts going up. Otherwise, I can't really tell what that pink line is if it's not a phase 4. So either that phase 4 has got to be broken, or that pink line's got to be broken to the side and come back and retest the phase 3 before going higher.
So here's kind of what I would be looking at is back here. This would kind of be the similar situation if we're looking back in the 95 to 98, where we broke through the top of the channel. This was with serious conviction. And then you kind of get a little pullback that would have looked like an ideal phase 4 line, but it doesn't really happen. But it makes a new all-time high, makes a new all-time high, and then eventually it gets there. So that's kind of how I would be looking at it, in the sense that we are kind of right in here. Let me see if I can highlight that for people. Kind of like that.
Interesting. Yeah. Where
it looks like there's something to draw there, but it just not. It's struggling. That's kind of how I would be viewing it. Just because this isn't quite it just isn't an angle for this. Would kind of be like the Apple phase 4, where it's like, yeah, I guess I'm drawing it in there because it meets all the guidelines, but it does not make me feel comfortable that I'm right. That's kind of how I would be feeling there.
But going to my thought that phase changes appear at vertices or vertexes. That's why I'm saying the vertex should occur on or around the phase 3 line. And the only way to do that is either if that pink line turns out to be phase 4, or the pink line is broken and you move over to the phase 3 line so you can then get a vertex up into phase 4. Otherwise, you've got an enormous space between the vertex between 3 and 4.
Tyler.
Yeah.
Question from the live chat or chat.
Right.
Maybe it doesn't have to be a perfected vertex?
Well, that's possible. We've certainly seen them before. It's just that that's what you want to see. Otherwise, well, this is such a weird one anyway, because you've got a nested hyperwave back there a long time ago, and now you are clearly in something new, but the question is, what is it? Is it actually a hyperwave? And because that phase 3 line has got so many touches against it, that looks really good. So if you were to, so where is your vertex for a phase 4, unless it's out in 2022 somewhere before it really takes off. Let's just say you go straight up from here, directly up, and you just keep going at the angle that the last 5 or 6 weeks are going, and you just keep going higher and higher and higher.
Yeah, so I was never, until I attended your workshop in Vegas, I never considered the vertices as that important. So that was never something that I paid attention to until recently. And it sounds like they're very important to you, and I have absolutely started to pay much closer attention to that. And to kind of try to answer that question from live chat is, I think of it as a spectrum of on one end, we have the most perfected hyperwave that there has ever been. Everything comes together perfectly at the vertices, the angles are all there, everything happens perfectly. On the other end of the spectrum, there's like the sloppiest, messiest hyperwave that we would still consider a hyperwave. It still meets all the requirements. And on this end is going to be some hyperwaves where it just doesn't come together at the vertices. I've seen a number of charts where they don't come together at the vertices, but it fits the archetype. So like right here, in the past, I have never had any problem with just kind of drawing it like that and not having it not come at a vertice. And only recently am I starting to realize that that may be much more important than I'm thinking. So just in response to the question live chat, that's something that I was always okay with in the past if it didn't come together to vertice and didn't hardly think twice about. And now I'm starting to consider a lot more. And potentially this will be one of those that are on the other side of the spectrum where it does meet the rules of hyperwave, but it's not the most perfected example that we've ever seen. And like Tyler says, which really resonated with me and what's made me think about this is the more wiggle room you give yourself, the more you wiggle away from the ideal end of the spectrum, the less likely it is to honor all of the rules. And that's very important. So if you have like a really messy hyperwave on this end of the spectrum, then I would think it's much more likely to have a phase 6 that exceeds the phase 4 high. It's much more likely to have a phase 7 that doesn't get back down to phase 1. It'll be more likely to break those rules if it's not as perfected. And that's something that definitely looking at the Bitcoin hyperwave, that one is very perfected, and what makes me very confident that it will honor the rules. Whereas in other markets, I think that, there just could be some flat out manipulation occurring or like some weird things happening that causes it to not quite meet these rules. Like, I don't want to get into this too much, but Tyler's talked about like the plunge protection team and that the government will potentially step in and buy futures when we're crashing. And if that's what's happening right here, then, and it didn't really happen in the past, or it's happening more pronounced, or maybe money's getting printed, whatever the case may be, maybe there's something that happens that causes this to not quite make the most perfected hyperwave. And if that's something did happen that affected this pattern, then it's more likely something could happen in the future, because this pattern is so powerful that there's so few things that can do anything to it, that when you do see it kind of wiggling away from the rules that we've seen work so well, that's when I would just kind of start to say that, yeah, it's still in that spectrum, but I wouldn't be as confident in opening a huge short at the top of phase 6 and using the top of my all-time high as a stop. I wouldn't be as confident in saying for sure it's going to return to phase 1. That's just how I think about that.
Tyler,
Yeah.
as a response to our wonderful Socrates in that, I'm going to evoke what our description in our webinar says, because I think that will be important to answer all together, which is just talking about this. Why does sometimes the phase 6 occur, phase 5 so violent, sometimes 7 so maniacal? And, if you can get to it, some people asking, if you could talk a little bit more about funky. What does that mean? Because everything's looking kind of crazy.
What was that word you just said?
Funky.
Oh, funky. Yeah, right.
And this is a perfect example.
Clearly, this is a funky hyperwave, and the reason is because we did not return all the way down to phase one in 2003 or in 2009. You returned to phase two, and therefore it held. And now we have taken out the highs of 2000, which means that this three is on the original hyperwave going all the way back to the beginning, well into the 1980s. So this is becoming an enormous hyperwave that is actually a funky hyperwave off of a phase two. So that means a lot of things to me. Very quickly, the biggest we've ever seen is 80 years long. We are now looking at an enormous hyperwave in which we are only in a phase three that has gone on for almost 10 years. A phase three that has gone on for almost 10 years. Now, if you say phase four is going to be half as long as a phase three, or even a third as long, that means you're talking about a 3 to 5 year move up from these levels off of phase three. That's why one thing that I'm thinking is that you had that four drawn correctly through the bottom of this last pullback, but you're beginning a run to something like 2025 potentially, in which, even though that angle doesn't look huge, the price can go enormously high. Remember that this is lagging the other big indexes tremendously. We only took out the peak in 2000 back 2.5 years ago. And since that peak, we have only gone from approximately 5,000, 4,800 up to 7,600, or something on the order of a 50% move, or a 25% to 30% move. Whereas back in 2000, the Dow was trying to get over 10,000, and we are now at 26,000. So the stock market in general is way ahead of this chart, which could very well mean that if we've got a 1 or 2 year bull market ahead of us, if the S&P can break above 2,800 and the Dow can break above, let's call it 27 or 28,000 up to 30,000, so that all of these are in line, this one's got a lot of catching up to do. And because I believe that the original hyperwave back in 1995 through 2000 in NASDAQ was based not on dot-com stocks, but was based on this macroeconomic event of new technology, it would be very easy to build a case for us going from 7,500 up to 20,000 on the NASDAQ over the same period of time that other markets worldwide are beginning to get stronger and stronger. Now, the flip side of everything I've just said is I am not yet confident that any of the other indexes are breaking out, even though they're trying to. And that would indicate, if they don't, that we have just seen the terminal move in the NASDAQ. And this pullback that we have seen actually broke a phase four. The phase four line from the phase three up through that accelerated move to the top before this downturn, and we are indeed in a phase six right now. So that's the way I think about all of these things, is what are all the possibilities, and then step back and step back and step back and look at all the evidence and don't draw any conclusions, but be prepared to be flexible enough to understand that what we're looking at isn't the price here. What we're looking at is the structure of this weird thing called a hyperwave. And that structure allows the price to do anything it wants as long as it doesn't break down these phase lines. So anyway, very interesting stuff. I love it all. This is great. Did you have another chart you wanted to bring up?
Yeah, at least one more, depending on how much time we've got, and at most two more, I believe. And you brought up a very interesting point there that I'd never heard brought up before, that I'd never considered myself, in that the length in time of phase 4 could be a function of the angle, or potentially the other way around. The angle could be a function of the time. That would be the better way to put it, in the sense that if we're expecting a 10-year phase 4, there's no way it could occur at a 40-degree angle, like a 45-degree angle. The only way that you get these violent, straight-up phase 4s is when they're very short in duration,
right,
relatively. So if we are to expect a longer phase 4, then we should expect it to be at a less violent angle, which makes it more sustainable. That's something that is very interesting, and I had never considered before, and makes me feel much more comfortable with drawing the phase 4 like that. So that was a great point. So definitely wanted to just take a look at the S&P. Basically with the Bitcoin, I was going to show how I used to draw before understanding how to draw phase lines. I was always looking for parallel channels. That's what this is expressing. No need to go into that very much, but essentially anytime you see a parallel channel type of formation in a hyperwave, I think it's something that is very important to pay attention to, because breaking through the top of that could have some big implications. That in mind, let's take a look at the S&P. So this is one where we originally would have put it here. It kind of broke through, didn't really advance, struggled along it, was turning it into support, but didn't advance at all. Came back down, found support, and then here we go. It broke through in 2017, and then it looked like, okay, here we go. This is looking like a phase 4 move to me, very much. And it didn't. Basically, we broke through, we advanced a lot, we came back down, we retested, we didn't even. Excuse me, I'm sorry. I would have moved it up after this. Didn't really work out. So now we can kind of see that it broke out hard, came back, retested, kind of wicked below but closed above, tried to break down below, failed to do so, and then goes on to create a new all-time high. So when I was describing how confident I would be in the NASDAQ, basically that's what happened here, and it didn't pan out. So just keep that in mind, where we break through with conviction, turn it into support, and then also kind of leave some gaps in price where we don't come back to horizontal, and then we make a new all-time high. When this happened right here, I was telling my family, my friends, everyone, that it's time to get in and get in big, because just like I'm seeing with the NASDAQ, we break through that, turn it into support, and then make a new all-time high. That's all the confirmation that I could expect to have. So let's take a quick look at the 30-period RSI. And here we go. What is this going to tell us? And it kind of confirmed, in the sense that we did get up to 80 here. We're ready for a parabolic burst continuation, is how I'm seeing it. We're up at 80 on the weekly at the beginning of 2018. And beginning of 2018, looks like the weekly was above the daily, at least for a period of time. And once it did get over 80, that is parabolic high risk. We've got this move. Let's go ahead and throw on the that kind of 10 period, and we do see that yes, You see how it was just the whole time. We have one close below it, which could have gotten you. But basically, this is what I'd expect to see in a phase 4, where you have a short-term moving average or exponential moving average that the price continues to stay above and support. So here, this really did look like a phase 4. But it didn't get anywhere. I mean, the returns were nowhere near what you'd expect to see in a phase 4. So this is one that it's just really interesting to me in that it kind of it doesn't support the rules that I have grown to believe in a lot. So basically, for this to get up to 80 on the daily and the weekly, I would have expected a 2x gain. I mean, from when you go into phase 4, you're really gonna expect to see a 2x gain or more from the phase 3 that you had. So that's where this is just very, very interesting to me, in the sense that everything looks and smells like a phase 4, except the return. You only go from, let's call the phase 4 starting kind of here. We're at about 21 up to 28, what's that, 30%, something like that. That's not a phase 4 to me, but everything tells me that it is. So that's where, going back to my original point of drawing hyperwaves versus trading them in real time, it's easy to draw them. After this webinar, every one of us is going to be able to go through some charts, recognize a hyperwave, and draw it. But when it comes time to put your money to work, that's when this really, comes to life, and the black and white rules become very important. So here we are again, kind of retesting this, and if it is able to go ahead and break through it, it wicked off just beautifully, absolutely beautifully from essentially. You're seeing my chart here as this is all being labeled phase 4. So I'm just realizing how confusing that would be. But there's a number of ways that you can draw the S&P hyperwave, in the sense that I haven't seen anybody else really draw it this way and this long. Most are drawing it differently than this. So I'm just kind of realizing how confusing this may be, but it does point out just the original point I was trying to make of struggling to break through this horizontal line. When it does, you expect to see a big move. When that doesn't happen, definitely time to pay attention. Can't really draw many conclusions here, other than if it does create a new all-time high back above this, it's going to be in a very, very interesting spot. Again, one that's maybe not on the most perfected end of the spectrum, but we learn the most from the ones that are on the other end. Once you can distinguish the messy ones that still are hyperwaves, opposed to the ones that are very close to hyperwaves but aren't, that gray area is where we really improve our understanding. And then if we still have time, I just wanted to go through a practice trade, basically a trade that I just opened to help to show people how I calculate leverage and how I am willing to go ahead and put my money to work, if we've got about 10 more minutes for that.
Yeah, let's do one thing really quickly. Why don't you get out of screen share? I'm going to pull up yesterday's charts, and we're going to go through the phase lines very quickly for those that missed it yesterday, that are joining us from Las Vegas. And then we will talk about ways of putting trades on, taking trades off. We'll run over, but that's okay. Anybody that wants to go through this with us, that will be good. I am going to go here, and then I am going to bring up, I think it's this one. Let's just give it a shot. Yes. Okay. And then we are going to go here. Okay. We are quickly going to go through about 14 charts, the same ones I just went through over in TradingView, But these are charts where we have drawn phase lines. This, again, is AES Corporation. And this is a clear phase one, which is not a hyperwave, but you are interested in it because of this breakout. Now, sometime in the next months or years, this could develop into a 2, 3, 4. Right now, all you know is we have a very long period of time, almost 10 years, 9 years, and now a breakout above a horizontal trend line. So keep that on your radar. Here is LRCX. And anytime you want to jump on in here, LRCX is Lamb Research. We pulled it up looking at various ways of looking at it with Consensio, but here is a long phase one broken in 2016, phase two pullback. Even though we've gone much, much higher, we've gone from 60 to 230, almost 240 in a phase two, which means this thing could be enormous. It is not a hyperwave. You bought it because of the breakout and the pullback of a phase one or a horizontal trend line, and now it is lining up to maybe be building a phase two. That is LRCX. I want to take a look at this one, which also is a phase two that we looked at yesterday and said, well, we could have drawn it here. We could have done, this is the right way to do it. Price is not determining the phase line. The phase line is determined after a vertex with multiple pullbacks. You might have gotten excited and said, well, maybe a phase three is beginning, but this proves that the phase two line as originally drawn was still correct. Now the question is, has a phase three started from this vertex up through something that's going on here? Too early to tell, but very interesting. Obviously, if you bought the breakout of a one, you don't care. But as it develops, you get more and more interested in, is it taking on hyperwave qualities? Or am I simply going to ride it and get out either using stop and reverses or the sequential trading system or Consensio or moving averages or all the other tools available to you. For now, this is an interesting two that is going on for a very long period of time. Here's one that looks like a three, which is Kimberly-Clark. No, this is 3M. Where did Kimberly go? There's Kimberly. That's the one we were just looking at. Kimberly was there, and this one was AES, and this was Lamb, and this is Kimberly. Very long one, broken. That's why you buy it, not because it's a hyperwave, but because maybe something's going on, the pullback, something is going on. What's going on with three? Are we starting a three? Too early to tell. Here is one that has started a three, which is 3M. And it's very interesting. You bought it because it you jumped above a long phase one or a horizontal line, which you can't call a phase line until you know that something else is going on. A pullback gives you this two. At the vertex, you get a three, and 1, 2, 3 touches after the vertex. Now it's come over to it, but hasn't taken it out, come down to it, hasn't taken it out. Looks to me like it's still on a three. Big company. This is a nasty pullback. Consensio would have you mostly out. A lot of other things, stop and reverses, would have you out or thinking about being out way up here somewhere. But to me, it's looking like A hyperwave. Now, what I said at the beginning of this segment was that all of these are going to break down, all of them, if the stock market rolls over here. If the S&P cannot continue up, if the NASDAQ chart we just looked at cannot continue up, and they roll over and they go to lower lows, then all of these things are going to collapse. Therefore, you've got to look at the big things as your.
Could I ask you a quick question on that last chart?
Of course.
So you mentioned that Consensio would have gotten you out, and I do apologize, I missed some of this morning, so I'm going to have to rewatch. So if you already talked about this, just go on to the next. But when will you go, when you're trading a hyperwave, when will you start exiting due to Consensio, and can that potentially help us understand what phase we're in? Because we know that phase 4, we will use, following the rules of hyperwave, if it's in phase 4, we're always going to get out before Consensio tells us to by using hyperwave, right? But here it seems like Consensio would get us out while the hyperwave is still intact. And to me,
absolutely.
I would be inclined to disregard Consensio there. What would you do?
Yeah, I wouldn't. I would use Consensio or stop and reverse points as a place to get out. And if you can buy back in near the 3, that's what you want to do. You've got huge room when you get these big moves up off of the phase lines, remembering that the phase lines are not affected by the price. Therefore, if price wants to do stupid things and go way, way above a phase line, use shorter term tools to at least take profits. And maybe if you're really gutsy, buy puts down back to the phase line. And if the phase line breaks, you have got your stops right below the phase line. So the phase line allows you protection. You assume it's going to hold, but if you get too far above it and you've got techniques that you like, such as Consensio, that will get you out clearly because moving averages are going to roll over very quickly. Maybe it's just going to get you out 5, 5, 5, 10, and maybe 25, depending on what's going on. But you're taking profits, and you're looking for, oh my gosh, there's a floor coming up here. Maybe that's where I'm going to re-enter even before Consensio. I wouldn't do that. If Consensio is continuing down and stop and reverse are below the are above the price coming down sharply, I'm going to, because I've got money in cash, that's where I want to be all the time, is in cash, unless I've got overwhelming evidence that I want to risk that money in some asset class. Well, that's exactly what this is when you get pullback, and that's the way you play above a hyperwave phase line. When the phase line is broken, then all bets are off. You clearly are going to respect a weekly close below the phase line. But we haven't even gotten to 4 yet, so you don't want to assume that this is one of the 15% that will break that phase line. You assume it's one of the 85 that's not going to break the phase line until you've got a 4. So the other question is, could this be a 4 coming up here? And we don't know that yet. There's not enough evidence in, but it could be, and this could have been a 5, a 6, or working on a 5 and a 6, and then something else. Too early to tell. But what isn't too early to tell are these other remarkable things like Consensio or stop and reverse points or sequential systems that you look for the 9s, and when you get a 9, you expect a 1 to 4 pullback. And if that pullback becomes more than 1 to 4, you just stay out of it until you've got more evidence. So that's the active part of what we wanted to make sure everybody heard. Great question. Okay, same thing.
That was a great answer. I just wanted to, I guess, kind of try to sum it up that that it's the most conservative option. And I've left some money on the table there myself, being too confident in the hyperwave pattern. But if you've got these tools like hyperwave and Consensio, once one of them tells you to get out, take the most conservative option. So I think
that's exactly it. On the other side, on the other side of the trade, looking for a bottom like on Bitcoin, you don't do that. You don't do that. Hyperwave tells you to stay in cash, so you don't try to speculate against it. Because speculating against a major trend when the Consensio is going down, when stop and reverse are going down, when hyperwave is going down in a phase 7, when everything is negative, you don't go against that trend. When everything is positive and you've made money because you've made that move out of cash into this thing, now you want the first chance to get out of it. You look for any reason to get out of it. And if that reason is way above what you know is going to turn out to be support, this is a great example here, which is a biomed, where if you had gotten out using stop and reverse or Consensio or sequential or anything up in here, you're sitting fat in cash as this is going down. No assumptions, sleep at night, and then lo and behold, it actually holds right on the line. So this is where you put the cash back to work with stops right below the phase 3 line. This is where you buy calls with stops right below the phase line. And then if it works out and this thing keeps going up and you go into a 4, great. You're in a position. So perfect question at the perfect time. So here's a biomed, long one. Yep.
Never mind. Keep going. Go.
Okay. A biomed, long one. You buy it not because of a hyperwave, but because of a breakout of a horizontal trend. Lo and behold, the 2 looks like it's going on. It doesn't last very long, but it's long enough. It goes from 2016 to almost 2018. That's a good phase 2. Phase 3, very simple, angles up. You use some of the techniques that Socrates just talked about these highs. When you take the highs out and you come back and you test them, you're probably ready for something exciting to happen. You do. You accelerate up. Here's the highs. You come back. What do? You test a phase 3 line, go up, on and on and on. Step by step, always thinking about, I want to be in cash. Get me out of this stupid thing. Get me out of this trade so I can get not only my cash, my principal, but my profits, and now look for a re-entry point. Okay, let's take a look at this one real quickly. This is APD, Air Products and Chemicals, which is an incredible chart. We looked at it just trying to assume this isn't a hyperwave, but now you've got building evidence that not only it is, but it's beginning to accelerate up again. This is the area using either Consensio or stop and reverse points that I would respect, because you're so far above this 3. You step aside and you're sitting in cash, and this thing goes to the moon, and you should be going terrific. I hope a lot of people make a lot of money. I've already made a lot of money, but I'm not going to play with my principal or my profits unless I get a pullback to some level, or Consensio begins to curve around and start back up, or stop and reverse, get hit, and therefore become support. And at that point, you then make your decision, how much money do I want to put back into this trade? Remembering that you're still way above this phase 3. Now, could this be the beginning of a phase 4? Yeah, it could be. There's all kinds of could, shoulds, and woulds, but just keep the principles simple, what you're trying to achieve. You're trying to take hard-earned dollars that you spent hours and days and weeks and months and years accumulating, and it's safe in cash. And now you're going to make a decision to move that somewhere else. You always want to be thinking of, I want out of this trade. I want out of this trade. I don't care if I don't get the very top. And hyperwave gives you this unbelievable structure with which you can think about making those kind of decisions. And each one of us will make a different one because of where we are, what we're doing, what we're thinking, what we like, where, what gives us adrenaline rushes. Do we want to sleep at night? What do family members think? Or, all these kind of things are individual, but the principles remain the same. I love this chart. Okay. Yeah, go ahead.
Real quick, to reiterate your point with one of the favorite quotes I've ever heard that is, I really have taken to heart, is that if you're diligent about managing your risk, if you're diligent about managing your stop losses, then the winners will take care of themselves. You don't have to do anything other than be diligent about managing your risk. And then once you get so far into profit, then you need to be diligent about managing that profit, in the sense that you can get into a trade where you're up a lot of money. Like you're up way more than you'd ever been before, way more than you'd ever expected, and you want to get out right now. Like you just have all this money that's right there in unrealized profit. And that's where Tyler's kind of saying, give me my cash back. I want to get out. I want to capitalize on profit. And that is very real when you're looking at these numbers on the screen that are an enormous amount of unrealized profit. And it almost can become hard to hold on to the big profitable positions when you are only focused on managing your risk, and that's your main focus. And then you get one big winners. That is absolutely going to be your concern, is not getting out too early, but absolutely getting out as soon as you are told to. That is that's a very important balance, that if you can learn to manage that, then you're going to do very, very, very well. And that was just another chart I wanted to point out. Did not come together at a great vertice. Here's another one, not a great vertice, but looking at how clean everything else is, that maybe it doesn't have to come together at the best vertices. Some of those charts we were looking at earlier, and one of the questions that was asked. So there are some of those examples.
Absolutely, they are. This one is occurring below this price action, but it works, and every time it's proven, then that establishes a stronger belief in it. Always remember, though, you don't get demerits for redrawing a line. It's your money. Use the principles and do what you believe is the right thing to do, but be flexible on not only bringing in other tools to help you make these decisions on where you are and what you're doing. And this is probably my favorite chart of all, which is Amazon, which appears to be in a 3. A lot of people thought it was in a 4. That's a strong enough move at a strong enough angle, and that might be correct. We don't know yet. It might have started right here at a vertex off the 3, come up, and we broke it, and we are in a 5, 6, headed to a 7. You don't need to know where it is going. Just be aware of that possibility that this 3, even though it held here, is actually either a 5 coming down, and if broken, then not only was the 3 broken, or this 5 is real, and then you're going to get a 6 and a 7 after that. Or we haven't seen the 4 yet. You do not need to know the answer to that question to accurately play this, but you must be aware of exactly where we are and what we're doing. If the stock market rolls over, if the other FANG stocks roll over, this is a 5, 6, and a 7. You don't know that yet, but be aware of that as you're watching these. Just one thing
I've been watching on Amazon is that the top end of the channel that I like to draw, this last pullback, I would have loved to see it find support at the top end of the channel. That would have told me that potentially phase 4 hasn't happened yet. Since it didn't find support at the top end of the channel, I'm more leaning towards this being a phase 5 move. And anybody that was in Vegas, I drew this as a phase 4 and a phase 5. So this is a very, very interesting chart that can be interpreted in a lot of ways. And because it didn't find support at the top of my channel, it doesn't appear to be turning resistance into support, which just kind of leads me, I'm close to 50-50, but kind of leaning towards the phase 5, just looking at this chart in and of itself without looking at anything else. So that's just an area where I'd be.
And everybody, I know everybody's thinking of this, but you've got to keep this whole thing in mind. The world debt problem, the potential of the longest bull market in U.S. history running out of gas, some things beginning to show up in Netflix and Apple and Amazon, leaders, and we're not sure. We're not sure what it's telling us. But if the stock market rolls over here, this pattern has got an 85% and maybe more, depending if this is a 5, 6, and a 7, probability of Amazon returning to $100 a share. Now, forget Amazon. That's one of the sprinkles. Think about the cake. Think about what we're talking about here and why you need to be prepared mentally for all the possibilities that are developing on a worldwide basis, and why it's so critical for the S&P struggling right below 2,800 to just pop a little bit more, and for the S&P, NASDAQ, and the Dow to go to new highs. Because then a lot of these sprinkles are going to resolve themselves into this is actually a 3. And we haven't even begun the 4 yet. And the same thing with these other charts that we're looking at. And that's why you want to don't end up focusing too much on any of the details until you've got a good, clear picture of the overall what's going on. This is AME, which is Amitech. Another, very interesting 2 to a 3 around a vertex. 3 held very nicely over here after the big run up. Was this a 4? Maybe, maybe not. We're seeing a lot of charts that look like this, an acceleration off the 3. One of the reasons I was so glad that Socrates took the time to go through all of these charts in very different industries, very different sectors, is to show the similarity of where we are across many, many types of positions. Here is a potential for, which is Abbott Labs that we've talked about earlier. Very difficult to argue the 1. The 2 does not occur exactly. You could bring it back here. It's not going to throw things off that much. That's minor details. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 touches. That's a real phase line. The phase 3 is very short. Maybe it extends up. We know that the theory is that you extend this until it's broken. Maybe this isn't a 4. Maybe this is simply an extension of a 3 that we're going to pull back to. Too early to tell. Keep your eyes on it. If it is a 4, we are close to that line, which means that you want to get out of this if you break that line. Not because it's a phase 4 line, but because it's a trend line that's gone on for over a year that would be breaking to the downside. So now you go back to your stop and reverse. Now you go back to consensus. Now you go back to RSI, a lot of other things, but very interesting. Keep your eyes on that one. Boeing, also fascinating. For obvious reasons. This huge move we just saw off of this thing that might have been a 4. Inexplicable. The 3 looks good. The 2 went on forever. So this is very hyperwave-ish. And we came right down to this point and this point, not at a vertex, but awfully darn close. keep your eye on this, because if the industrials and Boeing can be started in an accelerated move, we are so far above the 3 line that this has got to be a 4. And I am a seller of a big portion of my position, regardless of what stop and reverse or anything else says. Why? Because we're so far above this 4. And I don't want that 4 to break with me having money in it. Is it possible this is going to go from 400 to 800? Well, where did you buy into this thing? If you just bought it up here somewhere, you've got still a nice profit. I'd let somebody else play it to the upside. And a lot of people on Wall Street are jumping into it. I think it looks to me very similar to a broadening top, with either a 7 or a 6, a 5, a 4, a 3, a 2, and a 1 wrapped up here somewhere. And I don't like to be long a broadening top. I want confirmation. If we were sitting much closer to support, that would be a different question. That is not advice. That is simply an observation.
Quick question,
Yeah.
if we have time. At what point would you not consider that a broadening top?
There's specific rules about where you draw stops above a broadening top. That's my Selgin trading system. And basically speaking, that's too complicated. It'll take us too long. But basically, you set up a series of stops that run for 5 weeks in a row, 1 box above the high that was established with either a 5 or a 7 on a broadening top. And all that means is you are sure that it's about to go down, but you don't know from what level, and you put a stop above that price and you run it for 5 weeks. And then after the 5th week, you drop it at a 45-degree angle, the stops to the downside. And every week you drop it again another box, which if you just think of a chart paper with graphs, we used to do all this by hand so that you had all of the things. If you take a box that is a square and you move it 45 degrees down, what will happen is you draw a line across the top or the bottom of the boxes, and it's 45 degrees. So after 5 weeks of letting the top work itself out, you begin forcing it down like a stop and reverse point. And it works wonderfully well. And you can ride this thing all the way down for weeks, months, or years. Okay.
Sounds like a webinar in and of itself right there.
It is. We will get to that, we promise. Okay. This is very important one, ATVI, Activision Blizzard. Very good 1, very good 2. I like the 3. Sure looks like a 4. If it's a 4, then we're on a 5. If we're on a 5, we should expect a 6. If we're on a 6, we should expect a 7, all the way back down to nothing. So very important for chips, for gaming, for all kinds of great things. What's the possibility that this 3 is drawn incorrectly? We should go from this point on a vertex through this point over to here somewhere, and we're still in a 3. Possibility, keep it in mind. We just don't know. Would I be a buyer of this? I would be a buyer of this because it's so far below recent price activity, and look where it's screwing around right off of these tops. Maybe it's screwing around off of this 3. Hard to tell, but if the 3 was changed a little bit, I would definitely be a buyer off of these tops in that new 3, and then with stops below it. Don't take a big risk. You're not trying to go back up to the top. You're just saying that it's so deeply oversold that you're willing to take some money, X, and X is part of 15%, not part of 60% or 25. This is one stock. Now, if you want to do the entire industry and you want to put 8 or 10 stocks in this sector or this industry in that bucket, then you might cheat a little and take some from the 25 bucket. But I would only be putting a small amount of money in a trade like the one I just described. Okay, let's take a quick look at this.
Real
Because
quickly, could I
of
just
course.
a little quick input? Yesterday I said in chat that chart there would be my favorite long, ATVI, out of all the charts we looked at yesterday, and it was specifically because of your analysis. And I absolutely do think that I drew that phase 3 wrong, and I absolutely do think that you should adjust it. And therefore, I think that this is kind of either way. It could be phase 5 or phase 3, and it's a great long either way. If you buy it and it's a phase 5, it should still get a bounce. And if it is still phase 3, well, then much, much better. So when I did redraw the phase 3, I was trying to find it real quick. I didn't. Maybe I'll be able to include it later. But when I redrew the phase 3, it wicked off of it almost perfectly. And then we just closed a long-legged doji, a reversal candle that I like to see. And it's close to the 200-week moving average. Falling that hard and that fast into the 200-week moving average is something that I think is a very good buying opportunity. And I'm personally okay with playing counter trend bounces. However you feel about that yourself, this was the single best long out of the charts we looked at yesterday, in my opinion.
Terrific. Great input. Okay, let's take a look at Apple. We're trying to pick out very difficult ones that we know a lot of people are thinking about and overlaying it on hyperwave analysis. And here, very difficult to argue about the fact that this drop from $230 down to $140 wasn't a 5. Now, you can argue various things about this chart. The 2 is short, but remember, there's a very long time period, so it's reasonable. The 3 originally should have been drawn up this way, but when it came back down and then we double bottomed off of this new angle, that made sense, particularly when this came back down right to it and gave us a vertex. And that vertex then moved up. There's problems below the phase 4. We had breaks of it, including, it looks like, at least 1 week. Is that a close below it on a weekly basis?
It shouldn't be, but it might. I did miss one yesterday. I don't think that is. I think those are all wicks.
Okay.
I'll double check.
Yeah, that would be interesting. But other than that, if you're sitting here today and you're in cash, first of all, if you're sitting in Apple, you should have gotten out. Why? You were way above the phase 4. And therefore, you should have used Consensio or stop and reverse to get you out. If you didn't do that and you're still in, you should have had a stop below the phase 4 line. If you didn't do that and you're still in, now you want to think in terms of, is this a 5, a 6, and a 7? And in that case, how far is the 6 going to go? You have gone halfway back up to where you should have gotten out. So thank your lucky stars that if you're still in, you got half of your potential return from that point back and start scaling out of this. If, on the other hand, what we've been saying about some of the other charts are true, and what this is a return to a phase 3, and we never were in a phase 4, then that's a different question entirely. We are holding this top very similar to what we did in the last chart with ATVI. And that's interesting to me, but you want to be interested from the outside of a trade, not interested on the inside of a trade trying to figure out how to get out of a problem. Get out of the problem and reassess. Save as much as you can if you've made wrong decisions, like the 3 up here being stop and reverse, Consensio, breaking of a phase 4 line. that had the potential of being a phase 5 break. So this is one of the ultimate of important stocks in the tech area, which could tell us that the NASDAQ is not breaking to the upside but to the downside, that the FANG stocks like Amazon are not breaking to the upside but to the downside. This might be another example that has gone a little further than the other ones. So many options open to you, but you need to be on top of it, not behind it. You've got to be thinking about it before it happens. What are you going to do if you thought this was a bottom because of this, and you thought this drop was so significant that you're willing to ladder out of a position you're still in, then pick your points at which you will start getting out, knowing that this is a 5-6. It's not going to make it back up to the top. So pick a point, let's say up in here somewhere, which would be a pretty interesting looking 6 bounce, and begin getting out. Don't assume you're going to go to new highs. Get out here and hope it goes to new highs for everybody else in the world. And then you can reconfigure your decision. But what you've just done is gotten most of your profit back. And now you're sitting on the sides, letting the thing work its way out. Okay. We're way over time, but this discussion we're having is very interesting to me, and therefore...
Keep it going, Ty.
What's that?
Keep it going.
Okay, this one is GE, and I think we've got a great 1, 2, 3, 4, 5, 6, and we're in a 7. I can't read this chart any other way than that. People say, well, you should have drawn your 7 from here to here. You should have drawn your 7 from here to here. You should draw your 7 from here to here, which is the proper way of doing it, from the very top, but you should be prepared to keep moving that 7 to the right. The 7 is the only of all the phases that is completely flexible because of the maniacal nature of what it's trying to tell you. These guys are trying to get back to phase 1. To me, they have already broken phase 2. Because they've broken phase 2, they cannot be a funky hyperwave. Maybe they turn out to be a hyperwave that never makes it back to phase 1, but I sure wouldn't be betting on that with this little move that we've had from 7 back up over 10. I think we've got to go back below $2 or $1 on General Electric based on hyperwave.
One thing I'd like to add really quickly is what I find interesting but haven't had the chance to look into very much is how phase 7 can often create a Fibonacci fan. And when you're drawing trend lines, they get broken, and then you adjust the trend line, you keep adjusting, that starts to create a Fibonacci fan, which will give you a target of basically where you're drawing the trend line from. So a lot of phase 7s that continue to break that trend line, they start to create what looks like a Fibonacci fan, which gives you a target back up at basically the top of phase 6 or even at the all-time high. So that's something that I find very interesting and want to consider more. And anybody else out there, give that some thought.
Great idea. Great thought. I wish I had had the time to do a lot more Fibonacci work on hyperwaves. That's a whole area of study for people in terms of where the vectors, the vertices are, and also how high you eventually go and all of the rest of it. I just haven't had the time to do it. So another very important area, I think, to be considered. Okay, we're getting right down to the last ones. This is Netflix. This stupid 2 just drives me nuts, but it's there. So I think you can extend the 1 over, and all of this action is taking place above a 1, and the 2 doesn't actually start till over here. but I have no explanation for what the heck that is. Let's put that aside for a second and go through the 2, 3, the 4. We've got several people that have been playing this from the 3 into the 4. It looked like the 4 was coming to an end, and then it shot all the way up. The 5 looked good. The 6 looks good. Didn't get back up to the top. The size of them relative to everything looked okay. Then it all falls apart, and here we go all the way. Now we get this move back up to what potentially is a 7. I always draw the 7 from the very top, but it doesn't matter where you draw it from. Just know it's going to drive you crazy. Okay, what's possible here? What's possible here is that this 3 has held, and we never had a 4. We've seen that on 3 or 4 charts. Don't forget to extend your trend lines, particularly when you're going up into what you think is the final move. And simply by extending this 3 and maybe just pushing it a little bit, if that holds that point, then at worst, it could be a funky hyperwave. At best, you never had a 4, and all of this activity is above a giant 3 that's going to get even bigger into a much bigger 4 at some point in the future. You don't know. There's no way to tell. But just be aware of that fact. If we start dropping now off of this into some kind of a move that takes out this low, it's all over. This is a 7 and it's going all the way back down. What does it mean for Netflix to go back to $20 a share, $10 a share? I have no idea, but my imagination tells me that the market in general has got to have rolled over, and we've begun a big bear market, and now all of a sudden in play is the big kahuna, which is the debt problem. So you don't want to be, you've got to keep flexible on all of these things. I would be selling this. Why? Because this move has come up to a trend line unless it breaks it. So I've got to stop right above that line. I'm not going to take any risk on it. I will sell this with a buy stop slightly above the line. And if I'm right and this begins to come down, even down in here somewhere, that's great. I'll take my profit on the trade. If it breaks above this, I'm out of the trade and I'm waiting to see what happens at this 6. Maybe this is all part of a 6 and this is all a 5 down to here, and this is a 6 that then might go up to here and then might come back down. You don't know. Don't guess. No reason to guess, but list all of your options. Stay very, very flexible. And that is, I am going to say that at 4:43, we've already run over 45 minutes. But I want to,
Tyler, if you don't mind, sorry, just trying to interrupt real quick. It'll take me about 10 minutes to go through a practice trade.
I want to see that. That's what I was going to say. Before we end, I do want to, I said that I wanted to hear what you say about this thing. So please, go ahead. I'm going to keep, what I'm going to do is I'm going to stop sharing. Just want everybody to look at this chart one more time. This is real. This is not Sasquatch. This is a real thing. Use it.
Fantastic. Thank you for letting me continue going over. And I believe, am I on screen share now? Is this?
No.
Is your
face at the bottom, the green box?
Is that? Nope. Let's see. Share screen.
Yep.
Share.
Yeah, there you go.
You're good. Look at you golfing.
Sure enough, played in a virtual golf tournament. That was quite a bit of fun. We ended up finishing second. We birdied the last 3 holes to finish second place, and we lost by 1 to our best friends who were there watching us. So
very nice.
Quite fun. All right, let me move this to the side. So like I said, this has been one of my favorites to trade. Have been watching it closely, so just want to go through. I am a proponent of using leverage. Like Tyler said, if you've got a good opportunity, I see no reason not to use leverage. And as long as you're diligently managing your risk, if you're a profitable trader, if you've got a profitable system, then leverage is only going to exacerbate your wins. Whereas if you're a losing trader, then leverage is only going to make you lose faster. I mean, it's pretty much as simple as that. And one more point, that if your stop loss is inside your liquidation price, then I see no reason not to use leverage. If I am always going to be stopped out before I'm going to be liquidated, then why not use that leverage? That's just how I firmly feel about that. So if anybody has any arguments there, I would love to hear it. So this line isn't quite as important. So basically, I was looking at longing here, and I did get stopped out of my position originally because I was looking at this kind of channel breaking. We've got this kind of cup and handle action, this horizontal breaking through. Looks like we're going to the next phase, sure enough. So we get this correction here. We've got one correction, and right here is where that started. So we connect here to the first correction, and wouldn't you know it, that the price really respected that and really made it look like we've got a winning trade on our hands. And often you might be following a shorter time frame than the weekly, and you can start to get pretty excited when you see this trend line that you draw just really get respected over and over and over and over again. So I was building a position, feeling very confident. And then sure enough, we get the weekly close below right here. I remember typing in chat like, holy cow, like, this is below, but it's so close that I just can't imagine closing my trade right now. It was so close that I went ahead and let that ride. And once we got this close, okay, I'm out. And I'm considering shorting. And I remember talking to somebody privately about I'm not going to short because we got this horizontal support right here. So what I ideally wanted to see for a short was a return to that, a dead cat bounce to like that, and then this is where I was going to pull the trigger on a short. That didn't happen. Instead, it seems like we are finding support at a double bottom, and this just looks like an ideal big W to me. So I see that we are not returning here. We are finding support here. So now I'm like, okay, what's going on? Did I draw my phase line wrong? Could we be potentially using a different area? And I don't see why not. Instead of using this correction, we're using this next one here and seeing that it is kind of lining up like that. So here is a good example of trying to figure this out in real time and putting your money to work. When and where is it worth the risk? So right here, I decided it was worth the risk. After we got this last close on Friday, I just wanted to see a close above this close, and I was going to start putting my money back to work, mainly because this big W pattern really is a very reliable pattern in Forex specifically. If you are unfamiliar, just look up Bulkowski Big W. That is one that I really just I like. I am a proponent of double bottoms. I kind of disagree with many others in that sense. So here I am looking at this, which gives me a minimum target of the return to here. And I only really care about risk versus reward. What is the ratio? If it's a 1-to-1 risk reward, that does not excite me in the slightest. If it is a 5-to-1 risk reward, let's talk about it. Okay, so here I am looking at a pretty clear stop loss that's well defined at this horizontal support area. If you like, you can throw on the parabolic stars to confirm that. Nope, doesn't work because the stars are bearish. Maybe that tells you to hold off and not enter yet. Me, I feel comfortable right here because the stop loss is so well defined and the risk reward is so good. So here's how I would calculate my risk. And I was looking for my phone so that I could get my calculator, but I don't have it, so be it. So I'm looking at price of, first I start with my stop loss. And something else I wanted to say about leverage is the amount of leverage that you use doesn't matter as far as I'm concerned. As long as you know where your stop loss is and your liquidation price, the amount of leverage is irrelevant. All that I care about is how much money am I going to lose? How much money am I risking? If I'm standing to lose $500 on a trade, I don't care if it's 100x or 1x. It's $500. That's the metric that I care about. So first of all, I'm going to start with where's my stop loss, and I always give myself just a little bit of wiggle room. Like I might notice this candle here is just a little lower, you know, to save me from a trap, something like that. So I'm going to go with 5.07 as my stop. I write that down on a piece of paper. Next is what is my entry. So right here, I was waiting for this close. 5.26 is my enter. Write that down on a piece of paper. 5.26 minus 5.07. We're going to have to bust out my calculator on the computer. So let's see what we got here. We already heard enough about the golf. This will just take a second. Okay, calculator. So we've got the entry price at 526 minus the stop loss of 507. That's 19 cents. Divide that by the entry of 5.26. Our risk is 3.61%. Okay. Our minimum target, I'm always very conservative with my targets. I take the most conservative target I can. If this works out, I absolutely plan on holding a large portion of the position through an all-time high. I will basically trim. I'll take about 30% profit here, but this is what I'm going to use to understand my risk reward, such that this is, if I give myself a 5-to-1 risk reward, I know for sure that is a realistic risk reward, opposed to kind of fudging it to make it look better than it really is. So whatever risk reward I get here, I'm going to know that actually I expect even more reward, because this is a hyperwave that could really take off if it does break through that all-time high. So we're looking at $7.22 for the first profit take. If we go 7.22 minus our entry of 5.26, we get 196 divided by 5.26. We've got 37% versus 3.61%. We are looking at almost a 10-to-1 risk-reward ratio. Let's just get that exactly, because that's how I like to do it. We'll do 37 divided by 36. So right there, over a 10-to-1. We got 10.27 to 1 risk reward, and that is the minimum. I really think that if this gets above, if this retests the all-time high, it's going to break. This isn't advice. This is how I'm thinking. This is how I trade. I really think that if this does bounce from here, it's going to create a new all-time high. And if that happens, I think it'll get through 10. I mean, the 10 to 1 risk reward ratio is very conservative in my mind. It could be much more than that. So, all right, we've got a great risk reward situation. We now need to figure out how much do we want to enter? How big of a position do we want to take? So for me, I ask myself, how much do I want to risk? I don't ask myself how big I can get this position. How much do I want to risk? And that's a function of my trading role. If I've got, let's say, we're just going to use easy numbers. I've got $10,000 in my trading role. I really never want to risk more than about 2% of what my trading rule is. So just to make sure I don't make an idiot out of myself, I'm going to type this into the calculator. That tells me $200. I don't want to risk more than $200. That's the max. So if it's a trade I'm not very confident in, I'll risk closer to 1%, closer to 100. This is a trade I am very confident in, so I will be going with the full $200. So what I do here is I do 200 divided by the risk that we calculated. That's why it's important to write all this down. The risk that we calculated is 3.61. So 200 divided by 0.0361. That gives us $5,540. So that is going to be the exposure, because if we enter $5,540 and we get stopped out at 0.0361, boom, we just lost $200. We understand what our risk is. We're diligently managing our risk. We're going to let the profits take care of themselves. So that's essentially what I was doing here. I lost, no big deal. If I only need to be right 1 out of 8 times, basically, if I'm working with this kind of risk reward. So taking a loss is absolutely no big deal. So now we understand that our exposure is going to be $5,540. Now we want to calculate our leverage. How much leverage can we use and still have this stop loss in place, still have this trade how I want it to be? So essentially what we are going to do is go 100. I think I'm remembering this right. I'm moving quick to try to help time strengths, and that's right. So we do 100 divided by the risk, but you use a whole number. So this is something you might have to work through a couple times yourself, but okay, so you got our risk is 3.61%. So instead of using the percentage, we use the whole number. 100 divided by 3.61. 3.61 is our risk. That gives us 27.7. So basically, we can use 27x leverage on this and still be comfortable that if we still have our stop loss in place. I mean, it just doesn't matter to me. My liquidation price is a little lower than my stop loss. So why not use that leverage? And why not? And we're starting with the most important part, which is how much we're risking. And from that, we're able to determine how much leverage we are able to use. And that is a function of where our stop loss is, how much risk we're taking, such that we are never going to be in danger of getting liquidated before we actually want to get out. And that is something that you can use in your favor, such that if there's slippage, you aren't really a victim of it because you're getting liquidated. Essentially, you're minimizing your exchange risk by maximizing. I want my money in my control, in my hands. Even if I have my money on a regulated exchange, I feel kind of uncomfortable. If shit really hits the fan, I want my money in my hands. So I really like to minimize how much money I have on an exchange. So those are the two benefits of using leverage, whereas most people are thinking about maximizing their exposure. I'm thinking about minimizing my risk. And if you start from that, if that's your starting point, then you should absolutely utilize leverage to your advantage. And that is everything that I wanted to go over there.
Terrific. Very interesting. We should probably do at least a whole vlog on that where we could slow it down and use a number of examples. But I've followed it, but I've been doing this for a long time. Some other people might have had a little trouble with it, but I don't think so. It was very clear, very interesting. I agree completely with what you want to do is you want to worry about the risk side of the equation, not the reward side. The reward will take care of itself. Everybody's a genius in a bull market. Everybody makes money. That's not the problem. The problem is at what point do you get out and how do you know what to do? So thank you very much for that. I think, Leah, it's time for us to answer some questions if we've still got some people and some questions.
Pretty much no one's capped out yet.
Wow.
You guys are insane. You want to go, for another 6 hours? Thor's asleep, but I'm not, All right, let's do this. Guys, I hope you don't mind. I'm going to take the latest ones, guys and girls in the attendees, the most recent ones first, just because I think just in case they're going to be most relevant. So throw more in if you'd like, but we have 43. Ready?
Wow. Yes.
Okay, cool. Sure. Please comment on using options use in trading hyperwaves.
Yeah, absolutely. We won't go into all the strategies, but just know that what I was saying, each person is different. Each person has a different way of doing things. I rarely use options. I never do for clients where unless I'm writing calls to just buy premium or get premium for clients to increase their yield on various positions. But other than that, it's a very efficient way if it's a liquid security, if they have liquid options, meaning a lot of options. There's enough volume that whatever you're doing is not going to disturb price if you have to get out quickly or use a lot of stops. Also, you don't want to telegraph where your stops are. If you're a fairly big trader, it's best just to get in and get out quickly and efficiently, which means you don't have very many hours in the day to do anything else. With hyperwave, I keep stressing the fact that hyperwave isn't a price, it's a structure that there are certain rules that if that structure breaks down, it's very clear what you do. What's not clear is what happens in 2, 3, or 4 when you get way above that structure. Well, by definition, that's all profit. Because if you're in it, you're in 2, 3, or 4, that means you're long. And if you're long, if you get way above that area, above the phase 3 line or a phase 4 line, you have just made a lot of profit. You know that you will still have profit if you get back to the trend line or the phase line, because that phase line is moving up at an angle. So if the price is way above it, the tendency is to say, well, this is great. I've got a floor below me. And as prices go sideways, I'm going to run into that floor before the next leg up. And that's absolutely true. But here's another way of looking at it. Price goes up over a short time period so that it goes well above the phase line. Take your profit or buy a put in the amount or close to the amount of what you have in the trade. What you've just done is like buy an inverse fund where you're not sure what the next move is going to be. You just want to lock in your profit. If you've got $10,000 profit on a move above a hyperwave phase line, take the $10,000 profit by buying a put. If you've got 100 shares, buy 1 put. If you've got 1,000 shares, buy 10 puts. Now, what happens at that point? If this goes up, nothing. You've got exactly the same amount of money as you did before. You've got $10,000 profit. What happens if the price goes down to the phase line? Nothing. You've got $10,000. You made a decision to freeze your profit at a point above the phase line. Now, in the first case, when you go up even higher, you've just gotten a whole lot more information. Maybe you're starting a phase 4 and you're doing it completely protected, where you've got the ability to take one side off or the other. Well, which side am I going to take off if the price runs way up higher? I'm not going to take off the losing trade. I'm going to hold the losing trade in the put that I bought, and I've got all of my profit up here in something that's beginning to move up higher. And if the price comes down to the phase line, What I am going to take off is I'm going to take off the put. I haven't changed my total worth in the trade. I've still got my $10,000, but now I'm sitting on the phase line, which means I take off the put and I put a stop below the phase line on my long position. And now I can only take a little tiny loss. But if it's a phase line, what's probably going to happen is it's going to run back up. And when it does run back up way above the phase line, I'm going to put on another put, and so on. So that is one way of using it. Now, the other side of it is using calls. You can buy a call if you've been way above the phase line, you come down to it. It's a lot cheaper than buying a whole lot of something else, because you can buy a small amount of it at a very small price. And remember what's just happened. The price has just dropped down, which means the premium on the call has gotten lower and lower and lower. So you're buying a call cheap against a phase line. And as it goes up, the premium will expand, and you're going to be able to make a profit off of it. So you can use either puts or calls just themselves very, very effectively in hyperwaves at all levels. Off of a phase one, since that's not a hyperwave, but it's breaking above a horizontal trend line, that's a great time to buy a call. Now, if you've had a big run up from a bottom below the phase line, the premium has gotten very expensive. If you keep bouncing up under it, the premium diminishes, and so any break of it, you're paying a minimum of premium. Why would you do that other than buying a whole lot of shares? Well, the answer is because you're using up a whole lot of your money. Test it out first and see if you don't take a run and then pull back to the horizontal trend line. And then you can start accumulating shares. You could have sold the call after the run up, sold the call expecting a pullback, and either buy another call back there or start accumulating shares if it starts moving up again, because now you've got proof that you've gone from a horizontal trend line to some kind of an uptrend. You don't know it's a hyperwave. So in each one of the waves, different things are happening. A 2 is not yet a hyperwave. You just don't have the probability on your side, so you treat it differently than a 3 in terms of using option strategies, or a 4. 4 is the perfect time to use option strategies, where what you want to do is, instead of selling your position completely out, if you're way above a phase 4 line, you do, as I've talked about on a number of occasions, want to sell your position out, but use consensio or use stop and reverse points to do it. Don't wait for a phase 4 break. At a phase 4 break, you want to buy a put right below that phase line, right below the phase line. It doesn't cost you very much money, and you're going to be able to protect anything you still have on the long side to a certain extent by holding that put in what could be a 5. And then a 5 to a 6, there's a different way of looking at it. We will do a whole vlog on option strategies with hyperwaves, for hyperwaves, but it's a great question.
Last question on it. How far out should you buy the option?
Completely depends on premium. We've got a bunch of people that are playing hyperwave type of moves, and they go out very short. We've got people that only go out to the end of the week. You know, they play the Friday option expiration. But you can buy leaps that go out for 2 years. What better than when you go from a phase 2 to a phase 3, and you have just gone from a 1 in 5 chance to an 85% chance of success of buying a leap out 2 years. Why? Because the phase 3s last a long time, and then you still got a phase 4 to come, and only a 15% probability you're not going to get that phase 4. and you're sitting on this cheap thing, and you've got 2 years to go on it. Cheap meaning you've got to watch the premium when you're buying it, but something that has not been moving. A phase 2 is not moving very much. If you see a vertex occurring with the possibility of a move up, that's a great time to put on a leap. The leap just stands for a very long maturity option. And you can do leaps that are calls and leaps that are puts. So it's just the time element of it. So that there's no rules on that. Everybody has got to pick their own strategies, but use the hyperwave as your framework to figure out those strategies, or talk to option specialists about, I'm interested in this, how would I do it? And we will do a vlog just on that. We're piling up a lot of things that we need to do. We've got a webinar that we've promised people that we're in another webinar. We didn't get to everything, and everybody gets to hear that webinar free that paid for the first one, but we haven't done it yet. And we've got a lot of other things going, but we will get to that. People have been asking about option strategies, not necessarily with hyperwave, but in general, we will try to tie the two together.
Why the tolerance for 2 phase 2 lines on Netflix? Why would you want to consider it as a hyperwave in light of it not having the archetypical phase lines?
Well, because of all the things we've talked about over the last 2 days, that each one of these things is different, and there's no such thing as perfection. You've got an archetype, but an archetype is perfect. You know, all of the angles come together exactly right, and the lengths are about average for all of them. But in real time, you've seen us over and over again with examples that just don't quite make it. They don't fit. You've got to think about it. But then when you get tests along a line, that line becomes valid. You've just got to be prepared to do the right thing at the right time by thinking about it, and that takes time and experience. But most of these are pretty simple things. Remember that the bigger they are, the more probable your success is going to be, and more perfect hyperwaves they will be, because there's so many elements that have gone into it. In the Dow Jones, you've got 10 sectors and you've got 30 stocks. In the S&P 500, you've got 11 sectors and you've got 500 stocks across all kinds of industries. If that thing is in a hyperwave, it's going to be much easier to chart than Activision Blizzard, or even a big important company like Amazon or Apple. There's going to be, remember that's an important part of these last 2 days, is the hierarchy of what type of a hyperwave you're talking about. And the more illiquid and the smaller and the more volatile something is, the crazier the hyperwave is going to look at various points. The closer it is to really talking about major economic importance and shifts, the more it's going to act like a typical hyperwave, and everything in between.
Yesterday, I asked you a question and you said you'd get back to it today, which was actually Socrates' question. Which of the charts that we looked at today would in hyperwaves, or actually just which of the charts that we've looked at are you most interested in investing in? And someone in the chat actually then changed it to the safest investment out of those 15 charts. Or both.
I wouldn't limit myself to 15 charts. I will play hyperwaves in the 15% of my bucket in individual stocks. So pick out 15 of them and put 1% in each one of the 15. In investing, I'm interested in investing in the indexes and maybe in the sectors with 60% of the money. 60% means that if NASDAQ is in an uptrend, I will have 20% of my assets in that one thing. And if it's an ETF or a mutual fund, I'm just buying one security with 20%. I will put 20% in the Dow, 20% in the S&P, 20% in the NASDAQ as 60% of my portfolio, meaning my client's portfolio that I'm managing money for. I won't do that with any of these stocks. I'll do 1% or 2%, but I won't put more than 15%. I have consulting clients that will put 100% in one trade. They'll put everything they've got into one trade, like a lot of people did into Bitcoin. I don't do that. And I don't recommend that anyone does that. So I'm not going to pick out one of these and say it's my favorite, other than to say that I'm not going to try to play a 4 or a 5. I want to try to be in a 3 if there's a bull market. If Consensio says we're in a bull market, if the stop and reverse is below it, I want to pick out one of those stocks that's in a 3 after verification, not what it's doing, but what the bigger thing above it is doing. And then I will pick out the one that looks the cleanest. I'm not going to try to figure out how much is it going to go up or anything else. I just want to ride that hyperwave in that individual stock. And maybe if I really love it, I will go 2 or 3% of that 15% bucket. So maybe I'll end up with 5 individual security stocks that are in hyperwaves. And maybe 3 of those will be on the upside. It does not make sense to me to be playing both the upside and the downside, meaning 2, 3, or 4, and at the same time playing 5, 6, or 7. That's why I don't like Netflix, because nothing else was breaking down. Now all of a sudden, other things are breaking down. So now if I'm interested in playing 5, 6s, and 7s, I'm going to start with my 60%, then go to my sectors, and then I'll pick out a couple of these fun little ones and try to hit home runs with them. Because you're not going to get this percentage moves on the big indexes as you will on hyperwaves on these smaller things, even though Japan, the Nikkei, was up 40x. So hyperwave gives you plenty to work with without getting too tied to this thing. Now, there's 100 others than the ones that we've shown here. That's why I'm kind of hedging. And we're trying to figure out the best way to put all this stuff together, all of this information together. What we picked out for you aren't the best hyperwaves to be investing in. They are examples of how to look at hyperwaves with individual stocks that might be in 1s, 2s, 3s, 4s, 5s, 6s, or 7s, just to give you an example of how charts look for that type of a thing. We will be giving information to people that were in Vegas and in this webinar and in other workshops of hyperwaves that I love for a number of different reasons out of all of these things we're looking at. That's not what we were doing here. This isn't us trying to advise you to pick one of these and put money in. I just wanted to tell you how to invest in them after you, first of all, agreed that these are real things, and secondly, to understand that right now all of these things are related to some very big issues that are going on, so that you can start developing some tools to actually use them, not in the next week or month or 6 months, but for the next 20, 30, 40, 50, 60 years, understanding how it all works. This is a very dangerous time to be doing anything in the investing world. Buying stocks, shorting stocks, buying options, buying puts, buying calls, buying commodities, because of everything Leah and I have been saying for the last year. 2018 was an unbelievably difficult year where almost no one made money, regardless of what techniques you were using. And the only place that we could have really helped everybody in 2018 was to keep people out of cryptos and Bitcoin. The only reason we were able to do that was because of hyperwave. But in terms of giving advice about the stock market, should you be in and out? Should you buy this? We presented Consensio, because Consensio has the ability, if things are rolling over from a bull to a bear market, to get you out of that. That's not saying that we knew that we were entering a bear market, but we did know that it was something that people should learn after a 10-year bull market. So as we sit here just a couple of months into the new year, none of those issues are resolved yet. I can't advise people. I'm sitting 50% in cash, and in October and November, I was 100% in cash for my clients. I wouldn't look at any hyperwave in a up or down, or so I'm not going to make any specific advice about this is a great one you should be doing. We want to do is teach you the methodology on how to look at these things so that you can do it yourself and then interact with us, because we're going to keep doing vlogs. We're going to give you my opinion. Every time the stock market is moving, I've told you exactly what I think. I've told you what I think about gold. I've told you what I think about interest rates. I told you what I think about cryptocurrencies. And Lee and I will continue to do that on vlogging as much as we can, and anytime there's a change in what we're thinking about, everybody's going to know about it, particularly people that are learning the techniques. What these webinars are all about, and even our vlogs, isn't to be telling you to do something at a point in time, but for you to hear when I do all the stuff that I do, these are the conclusions I'm coming to. And if they're helpful to you, that's great. And by the way, we will take our time doing these webinars or doing workshops, teaching certain tools that you can't learn anywhere else. And I don't have a million of them, but I've got a half a dozen that have worked very well for me. We've introduced a couple of them, hyperwave and Consensio, and that's what this was all about. So it sounds like I'm dodging, and that's because I'm dodging. So,
all right, well, I'm gonna do one more on it because this is my favorite question in the Q&A right now. Thanks, Ant, but I will take out the profanity. If the stock market does roll over, should we A, short the heck out of the indices, B, short the heck out of the individual stocks, C, run for the hills?
Number one, you want to be completely out. You want to be sitting in cash. You don't want to take that cash and immediately do something with it. There's no reason to. That cash is wonderful. It'll be there a month from now. It'll be there 6 months from now. It'll give you plenty of time to think about what you want to do. You only short when you know that something is going down. You don't short because you want something to go down or you think it's going to go down. I very, very, very rarely short. I use inverse funds or puts to hedge positions that people don't want to get out of, either for tax reasons or they absolutely love Google and will never sell Google. Great. So I will persuade them. If I'm managing their money, they don't have any choice. But if I'm consulting with them, I'll tell them, just buy a put equal to, half of your Google position, and let's see what happens. And then wait a month or 6 months or get into cash if this market begins turning over. Lee and I will give everybody all kinds of notice from Consensio and hyperwave and everything else if we believe things are breaking down. Right now, we think things are breaking up. I'm on record as saying that 2019 is going to be positive for the stock market. So far, our clients that we're managing money for are up over 5%. Well, the stock market's up 8%. I don't care. I just said that in 2 months, we're up 5% out, and we've only got 50% in the market. I could do that for the rest of my life without feeling embarrassed or like I'm cheating anybody out of money, because their assets are growing in a very, very difficult market. But I am ready at the drop of a hat to go 100% into cash not to make money by getting out of positions and shorting, but because things are deteriorating and the probability is increasing that we are in for some bad times. And I am 50 S&P points away from going 100% long. So that's why I'm saying it's a very difficult period, but it has been for 14 months, not today, for 14 months. Nothing is resolved. Nobody has the answers. The technicals keep going back and forth. The fundamentals go back and forth. Trump keeps going back and forth. The Democrats keep going back and forth. The China keeps going back and forth. We don't know. And when you don't know, you don't risk money. You make the biggest money where you do exactly opposite what I just said. You put it all on black or all on red and you win. Great. Good for you. If that's the only trade you ever make in your life, put it away, put it in the bank, and never come back, because you're going to lose it all. So it's a matter of taking all these ideas and things and simple tools and complex tools sometimes, and just thinking about the money management side of things. We are not breaking down yet. We looked like we were back in October, November, December, and it stopped. And it reversed. And the movement up has been great, but we're not out of the woods. We can go either way, almost on a coin flip. If we go to the downside, we will let you know, but you should use the tools that you've learned, hopefully listening to us. Consensio will tell you to be 100% out, and it won't take long to do it. Just watch those lines. If you don't have time to watch those lines, listen to us, listen to other people. But it will become very apparent very quickly that a bear market is starting. We will be screaming it from the rooftops that we've got zero waiting. And then your question was, do we start shorting? I never have done that, but I will this time. The reason I will this time, meaning after we're in cash and have slept for a couple of weeks soundly, with all the media and everybody panicking and running around with their hair on fire, then we will look to risk money by going short. But we will do it incrementally, and we will do it in a very controlled fashion, not to catch 50% of a 50% drop, but to take the principle that we had, 100% of that principle, and have it grow in a down market. So that when we get to a bottom, if it's just a normal bear market, we've got a lot more money than we had at the beginning of the bear market. And prices are much lower, so we can buy twice as much as we could have before if we were just in cash, and a whole lot more than if we had stayed in with a buy and hold strategy all the way down to the bottom and our net worth has dropped by 50%, like it did in 2008, 7, 8, 9, like it did in 2001, 2, and 3, and like it will do either immediately or sometime in the near future, in my opinion. But the reason I would short it this time is because any downturn from here could be the trigger of the big problem. And I don't want to miss out on being on the right side of that call. So first you get into cash, and now you watch and you think and you measure and you take advantage of what could turn out to be a 20-year bear market for everybody else that isn't aware of how big this problem is. And if it starts to trigger things, other things are going to start moving in the opposite direction, like Bitcoin, like gold, like certain currencies. There will always be movement in the opposite direction, regardless if it's up or down. And that's what we will be looking to take advantage of after everybody is safe. Okay, enough of that.
Do you believe that hyperwave theory will work less accurately the more people know about it, or just the opposite, reinforce the patterns, like a self-fulfilling prophecy, or not have any effect at all due to being such a long-term pattern?
Yeah, it's a great, great question. Most people believe that technical analysis is self-fulfilling, that the more people that study Elliott wave, the easier it is to use and the more accurate it is. That has not been true since the 1930s. It hasn't been true with Prechter and Frost writing the book on hyperwave. It hasn't been true for the last 25, 30 years after they wrote the book on on Elliott wave. So the number of people that know something doesn't change its accuracy. Sequential was 75 to 80% accurate in the 1970s. Everybody on Wall Street uses it. It's still precisely as accurate as it was back then. The stuff Jesse Livermore talked about in the 1920s, the techniques that can be used, all the stuff about moving averages, none of that's going to change. No, but here's the good news. Nobody knows about hyperwave. 60 people in Vegas and 80 people here, some of which, that's a ton, we're going to write a book and the book's going to come out and hopefully we sell a couple hundred copies of it. So that's nothing for any of us to worry about. As long as we know it and we use it, that's great. And as many people as we can teach, I'm open to do it as much as we can. I love talking about it, obviously. Shut up, Tyler. Okay.
Socrates, did you want to chime in at all?
Yeah, I was trying to chime in on the last couple of questions, actually, because I've got some kind of unique and contrarian view that I haven't really heard anybody else talk about in terms of should we be shorting? And Tyler, he first started with you should only short when you know something is going down, and I completely agree with that. And I think that you should only long when you know something is going up. For me, I view shorting and longing as almost the same thing, almost. And I actually prefer shorting myself. I would, if everything is equal, then I would rather short than long. And when I say when everything is equal, to me, everything is risk reward. If it's a 10-to-1 risk reward to the downside and a 10-to-1 risk reward to the upside, to me that's identical, except for, and this is why I prefer shorting, is markets go down faster than they go up. So if I can get a move to the downside that happens in 30% of the time that it would take me to get that same move to the upside, then I prefer to be short. And most people I don't have that view because they are fiduciary for other people's money, and there's a lot of stuff going on there where there are other variables. However, if it's just you and your money, then I think it's good to think about this from a different perspective in that what is your goal? Your goal is to make the most money with the least risk in the least amount of time. That's why we love phase fours, because they get to their target in a short amount of time. So do phase fives. Potentially that could be a very tough short to catch. But for me, and this was another point that I wanted to make, was Tyler said that the best way to trade a hyperwave is you're in one trade, you're in phase three, and you're out. And you're out once phase five starts. Whereas for me, as I have gotten more and more experience trading hyperwaves, I am going to prefer selling phase six over anything else, for the only reason that it is easier for me to recognize than anything else. And it is also easier for me to understand the risk than anything else. I only care about risk, and I hate getting whipsawed. I hate getting chopped out. It happens. It's a part of life. You grow to expect it. However, it doesn't mean you're going to grow to like it when you're right on the direction. You think this thing's going up, so you long, and then you lose money, and then it goes up. That is, to me, like the most frustrating thing that there is. So I strive to eliminate that from my trading. So the best way that I personally have found to do that is by trading shorting phase 6 because it is the most confident. It's the most easy to recognize. Seeing that big, once you're confident that the phase 4 has gone up, and then you're confident that the phase 4 has been broken, this is the easiest trade in the game as far as I'm concerned. I cannot think of a better trade that I'm more confident in putting more money to risk at than shorting phase 6. And a big part of it is because the emotions that are underlying. Everybody's running around with their hair on fire, or they're becoming complacent in this dead cat bounce. Whatever the case may be, the emotions are the most rampant right here in this situation. In phase 3, the emotions aren't near as rampant, which to me as a former poker player, I just feel like the emotions are what give me an edge. When everybody else is feeling emotional and I'm not, that's where I can really gain an edge. So I love shorting. I absolutely love shorting. I crush it in 2018 shorting cryptos, because to me it was just so obvious where they were going, and it was much more easy to set up a trade than potentially going long, because it was very, very well defined where we were at. Whereas some of the trades we looked at today, it's kind of subjective. And that to chime in on the question before in terms of what's your favorite long, that was a question that I asked because I was kind of curious, and I was comfortable going on record myself that my favorite long from the charts we looked at yesterday is ATVI, and my favorite long out of any hyperwaves I've found is USD TRY, the Turkish lira, the trade that I showed you guys today. However, that doesn't mean that that's my favorite trade, because I prefer to short, and I find it much easier to identify shorting opportunities in hyperwaves than anything else.
That's great. And some of the things you just said are the most important things I would like people to take away from the last 2 days. We get excited about hyperwaves to the upside. I got excited about Bitcoin to the upside. But the trade was the last year to the downside on Bitcoin. I won't short Bitcoin, but all those other cryptos that I know are linked to Bitcoin, I will always regret not being in a position to take advantage of that. What we're talking about now are potential many, many hyperwaves that could be, if the stock market rolls to the downside, beginning very long periods of lower and lower prices. And so I would agree 100% that if you want the best trades in the world, you want to be short or have puts after a phase 6 and you've gone into this horrible thing called a phase 7 of a hyperwave, because you've got all the marbles on your side. And you want to do it as the 6 is going closer and closer to its peak. And you can ladder it and do all kinds of different things. You want to be completely in if you take out the lower levels of the 5. And just use Bitcoin as the example. Just take everything you've learned in the last 2 days, go back to your Bitcoin chart on a weekly basis, and analyze it step by step, not only up, but more importantly down. So that if anyone that has heard this for the last 2 days comes away with the conclusion that, yeah, it was okay to hold Bitcoin or hodl Bitcoin for the last year, that I hope a second time around nobody will do that with any asset class, because it simply doesn't make sense at any level. You will have plenty of time to get into Bitcoin at extremely low prices, regardless of where it goes right now, long before these big things are going to happen to the upside. So if you are like I am and you are a true believer in Bitcoin, a true believer, not in the fairy tales, but what it means, you know that something can occur where tomorrow morning it is $50,000. And you don't want to ever be short anything that has that potential. And there is nothing else I can think of that has that potential. Period. No stock, no bond, no asset class, nothing. Because of the big question, the big problem. And that's why from day one I said, no, I'll never short Bitcoin. But if Bitcoin is going down, you want to be short all the other stuff. But thank you very much for that. I agree 100% with you. And you've been stressing that all along when we were talking about the phases.
Ooh, can I chime in?
Please do.
Oh, just going to say that this is just like a funny little tidbit since we're over going on 5 and 40 minutes. So if anyone doesn't know the background on how it became HODL, then to be honest, talk about stupidity. Like in it, it's really a drunken dude who, super drunk, wrote hold wrong. That's how it became HODL. And he was saying that he's going to hold HODL, too drunk. He admits to being totally drunk. His wife was out because he doesn't know how to trade it. That was actually what is written. It is a hilarious email that was caught, and I recommend everybody read it and they'll more fully understand what we're talking about now too. Okay, Ty, back to you. I like this one, Charo. Thank you. When you're counting the broadening tops, you allude to 5s and 7s. I know that broadening tops are valid with 5 legs. What does having 7 legs imply? Is it more certain at that point?
Yeah, it's much more certain. And we call it a prime under the Selgin system. It was not identified by Wells Wilder Jr. or by Edwards and McGee. Edwards and McGee was the ones that called it a broadening top. And then Wells Wilder came up with his own system to trade it. And then the gentleman and I took what Wells Wilder did, and we came up with a very different trading system that we believe is far more accurate, that we call the Selgin system. And in that, what happens is just very, very quickly, when we say 1, 2, 3, 4, 5, what we mean is each step of the way is higher or lower than the one before it. So if a 1 is a peak, then a 2 is a valley, the 3 must go above the 1, the 4 must go below the 2, and the 5 must go above the 1 and the 3. That's a 5-step broadening top. And it often signals the end of a move. I was nervous about the NASDAQ early last year because it went through a broadening top, and it turned out that we were correct, that broadening top was saying this is a terminal point. And we had 3 of them all year long, and then we broke down deeply into December. Now, is that enough to negate the broadening top if we go to new highs? I don't know. But there is the possibility of going after the 5 down to a 6 that's got to be lower than the 2 or a 4, and back up to a 7 that's higher than the 5, 3, and the 1. And the probability increases much greater on a 7 than a 5. 5 is very good depending on how you look at it. Is it commodities or stocks and everything, and over what time periods and stuff like that, the probabilities go up, but it is close to 70%. And when you add the 7, it goes up even higher than that, even though the 7 has negated the 5. Because if you were playing the 5 thinking that it's over and dropping down, you were short that thing. And now it's turned around and gone even higher. So you've got to know that there's always a potential to go up from a 6 into a 7. And after the 7 takes place is where you put your stops. And we will show that on some charts where you've got all of the graph in, so you can figure out exactly where to put it. We will do that, I promise.
Socrates, you're off mute. Does that mean you're gonna scream at us?
Nope, I don't think so. Nothing to add there, really, though. That unless you got something else for me.
Let's see what we got. We got really good questions here. All right, I'm trying to do all the more specific Bitcoiny ones, hyperwave ones. Yeah, cool. All right, Ty. Is the rapidity of the Bitcoin hyperwave compared to other hyperwaves we looked at signaling anything special?
I don't know. I do not know because everything else I've looked at is not a Bitcoin or not in crypto. I looked at gold and silver. I've looked at sugar and cocoa, and then I've looked at these big ponderous things like Japan and the 30-year treasuries and the Dow index and even the dot-coms, which wasn't driven by the dot-coms, which themselves were wildly volatile, both up and down. But really that was an information move, and they got swept up in it, so people call it the dot-com bubble. But it was really a hyperwave that had been going on for a long time and still is going on today. So I don't have experience saying what does this thing mean that in literally a year, the beginning of 2017 to the peak, you go from below $1,000 up to 20,000, and then within a year you give up 3/4 of that. I don't know. I know that it fits all of the parameters of hyperwave analysis, and that's why I got into what we are now doing today with everybody. I've given you my impressions. My impression is it's the possible solution to the worst problem in the world, number one. Number two, even if that's not what it turns out to be, the fundamentals are so brilliant and so usable in so many ways to solve so many problems for so many people that it lives in its own world. It's got its own capability. And I'm not going to go off on a tirade about all the other cryptos and all of that kind of stuff, other than just to say that that's all been unfortunate. What's not unfortunate is all the innovation that's taking place on blockchains that are attempting to do different things, and they're solving a lot of different problems. It's just unfortunate that they had to become tokenized and they had to become centralized, but that's a minor problem. The innovations in the technology will not go away. So any of those projects that are ending up giving something that can be used at a later time is much more important to me than what the price of tokens are doing or the cryptos are doing or who's getting rich or who's not getting rich. I don't care about that. Fundamentally, this is an unbelievable new technical breakthrough for the world that has tremendous promise. And therefore, I would expect it to show up in something like hyperwave unusual activity in terms of speed and amplitude and all of that, and why I am so convinced no matter what happens, Bitcoin is not going to go away. It's going to be around forever, and it's going to do some huge things that I want to be a part of. I just don't know when it's going to occur, in what way.
So just an FYI, Ty, in 10 minutes, that will be the full amount of what I can keep recorded and downloaded. So just so we know where at least the video's tapped out.
Well,
we can keep going, but just letting you know.
Let's do this. Yeah,
we'll say they'll listen to you forever.
We've got lots of people in chat. Please write and send to Leah because she loves getting hundreds and hundreds of emails, questions, and we will do a vlog for an hour or 2 hours or 3 hours with the questions people have from this 2-day seminar. So for free, anybody obviously can listen to the vlog, but it will be just on that topic because we've gotten unbelievable responses from people in Vegas, and already the questions are terrific from the people here. So we will dedicate a vlog in the next several days to answering all those questions. We'll bring Socrates on, because a lot of them will be aimed at a lot of the great stuff he was talking about today. I don't want to cut it all off, but yes, I do. It's been a lot of fun. Leah's been great as usual. Socrates is a wonderful addition. Thank you all for not only giving us your time, but giving us what is significant dollars to learn. I think it is very well spent. I hope you do too. We are very grateful to everyone that has been following us and supporting us. And we will continue to do that as long as we can. We love what we're doing. Leah, any last words?
No, this was amazing. Tyler, you've kept this to yourself for 40 years, and I just hope that everybody knows how exciting this is for Tyler, for us, for both of us, that after 40 years, you got him to spill his secrets. This is actually the first time that Tyler has ever publicly done a workshop, webinar, seminar, anything on hyperwave. So it's really, really, really big and special and cool. And it's what we set out to do.
Our great pleasure. It was Leah's idea over a year ago, and I immediately embraced it and love it. And people like Socrates that have picked the ball up and have run across the end zone line so well with it, and so many others in our research group, and just so many other people. It's just fabulous. Socrates, any last words from you?
Yeah, I would love to. I just want to make sure that everybody starts to wrap their head around how groundbreaking this stuff is. Technical analysis has not been around for that long, out of maybe the last 100 years. And there's only a handful of people who've really made any sort of significant contributions. We're talking Wells Wilder, Shaw Baker, McGee, John Bollinger. There aren't that many people who have actually made contributions to technical analysis that can actually be used on a consistent basis to make money. The question is, now that people know about hyperwave, is it going to change? And I don't think so, because patterns continue to repeat themselves throughout time. And there are only a small amount of things that can consistently work. And even once they're out there, they continue to work. The patterns that were recognized in the classical books that Shaw Baker and Edwards and McGee put out, they continue to work to this day. So imagine that you are the first person or the first 100 people to learn about these new techniques. I fully believe that hyperwave and Consensio are on that level, if not even more so. I, as a former financial advisor, I'm very clear with some of the rules that you would have to that the SEC imposes based on risk reward and risk management and what you can and cannot promise. And I think that Consensio will rewrite some of these rules that we see on the books. If you follow these rules and you follow it step by step, you are going to make money consistently. You are going to pull money out of these markets, and you're going to do it in such a way that the risk reward doesn't even really make sense to outsiders. Like, there's some claims that you can almost start making that are kind of ridiculous and might get you investigated by the SEC if you have certain licenses. And I believe that in my lifetime we will see some of these things be reconsidered due to what Tyler and Leah are sharing with us. And to be on board at an early point, to be one of the first groups that is exposed to this, is a tremendous opportunity that I cannot put into words. It means that we have the chance to learn this stuff better and deeper and more thoroughly than anybody else. Anybody that learns this a year from now they shouldn't be able to catch up to us because we are so early in on this. I think of it like buying Bitcoin at $1. I mean, we're so early in these systems, these indicators, that it is just tremendously exciting. And I just want everybody to really think about how groundbreaking this stuff is, and how much opportunity it is giving us. I just can't even really put it into words, but I couldn't be more appreciative than I am for what you guys are doing. You're changing the world, and we are the first ones to be made privy to it. So just I want you guys to understand that and really internalize that, and get to work, because this is we not only are we getting these things, but we're getting them at a time that is the most opportune time to get them. We are in the right place and the right time to make a fortune trading hyperwaves. So I just want you guys to start thinking about that.
Thank you very, very much. I appreciate everything you've done. Thank you all for listening in. Be sure to listen to the vlog. It is coming, but you need to send in your questions. Leah's got a bunch of them already. The chat just keeps flashing at 99, 99, 99. Thank you all so much, unless you're all screaming at us for some reason.
Or sleep with the computers on.
Exactly.
That's what I do.
Thank you so much. Bye-bye.
Bye, everybody. Thank you.